So let's start. In yesterday's class, we had started with partnership accounts. Correct. So what we'll do is, I think we are okay with admission, retirement, death. Correct. No. So let's solve some problems from RTP, okay, with respect to admission, retirement, and death. Then we'll go to dissolution, and we'll finish partnership. Okay. So retirement of a partner. So what do we do in retirement? Retirement is also reconstitution of partnership. So we prepare revaluation account. Whatever reserves is there, we'll share it among existing partners. Goodwill calculation we will do. Then profits up till the date of retirement we will give him. Then if at all we have GLP or SLP, we'll do that also. I don't think we have that in this question. If we have, we'll discuss that also. So fast, let's finish it off. On 31st March 25, the balance sheet of P, Q, and R sharing profits and loss in the proportion to their capital stood as below. So the PSR is nothing but their capital ratio. This. So what is this? 50 is to 75 is to 50. That means 2 is to 3 is to 2. Like that also you can see. This is the old ratio. Okay. Then nothing else. Balance sheet. On 1st April 25, P decided to retire from the firm and remaining partners decided to carry it. Was agreed to revalue the assets and liabilities on that date on the following basis. Now, land and building to be appreciated by 20%. So this comes in the credit side of the revaluation. Plant and machinery to be depreciated, debit side. Stock of goods to be valued at 25. It is already at 30. We have to value that 25. So it is decreased. It will come in the debit side. Old credit balances of sundry creditors, 5,000 to be written back. So what is happening? Increase in liability or decrease in liability?
Increase.
It is they have not told written off. They have told return back. So old balances of some sundry creditors we had written it off, but now I think we have to still pay. That's why we are putting it back, writing it back. So it is increase in liability, which comes in debit side.
Should we add the same to
yes, of course. In your balance sheet, you have to add it back to creditors. Provision for bad debt should be provided at 5%. So this will come in debit side. JLP of the partners surrendered and cash obtained 18,875. So now JLP came off. Now it came off. Then let's discuss it off. So there are two kinds of life policies. One is JLP, joint life policy, and single life policy. What is this policy? These policies are taken on the partners by the firm. Okay. So who will be paying premium? Firm will be paying premium. Be it JLP. What is JLP? JLP is jointly taken on all the partners. For all the partners, one life policy. Okay. SLP, separate life policies for each partner. Okay. No matter what it is, JLP or SLP, premium will be paid by the firm. Okay. No doubt about it. Now, JLP. When will this JLP break?
When the partner is
before breaking, two values will be there whenever there is a life policy. One is assured value and one is surrender value. Okay, assured value means whenever you have taken the policy, this is applicable to both SLP and JLP. Okay, whenever you are taking a policy, you'll be paying premium. And the terms and conditions of policies, whenever a death of a partner happens, whatever money is guaranteed or whatever money is assured, that money will be given by the insurance company to us. Now, say suppose I've taken a JLP, joint life policy of 5 lakhs for all the partners. Okay. When will I get the assured value? Only if any of the partner dies. The moment any of the partner dies, I will get assured value. Okay. Say suppose assured value in our example is 5 lakhs. I will get 5 lakhs. Surrender value is what? Say suppose I'm paying premium every year. Today, I feel like I don't want the cover anymore. I don't want the insurance anymore. Then I will surrender the policy back to insurance company. If I surrender back, the thing is I would have paid premium for all these years till now. Will the insurance company give me entire money?
No.
No. They'll give a money lesser than what I have paid. So that money is called surrender value. Whatever premium I've paid till date, the surrender value will be a little lesser than whatever I've paid till date. If I want to surrender the policy back today, that is surrender value. Okay, both is applicable for both SLP and JLP. Now, how is this relevant with respect to retirement? Is what we have to understand. Now, tell me, whenever retirement is happening, okay. Now, I've taken a policy every year. A premium is being paid. Okay. Now, if retirement happens, first let's talk about JLP. Will I get the assured value?
Yes.
If retirement happens, is anyone dying? No one is dying. If no one is dying, then of course I'll not get assured value. At least will the JLP will be active for the future years.
No.
Why? Because it is joint life policy. Okay, suppose there are 3 partners, A, B, and C. Okay, it is jointly taken for A, B, and C. If C retires, then it is no more joint. So what happened? Policy broke because it's no more joint. But did they get assured value? No, because no one died also. So what will happen that day when retirement happens? The policy breaks and I will not get assured value. It's as good as I surrendered the policy back. I will get surrender value. Okay. If the JLP breaks on retirement, I will get surrender value. Say suppose we have SLP. Okay. On 3 partners A, B, and C. This is 2 lakh. Separate life policy. For A, 2 lakh cover. For B, 2 lakh cover. For C, 1 lakh cover. Now retirement of C happens. What will happen here?
They will continue.
Only C policy broke. Correct? A and B policy is still active. It is separate. A and B will continue. C broke. Did we get assured value of C? No, the policy broke, but he did not die. So we would have got only surrender value with respect to this. Clear? This concept understood. The same thing in case of death we'll discuss. This was retirement. In death, what will happen? Say suppose you have a JLP and one of the partner died. Will you get the assured value? Yes, you'll get the assured value because one of the partner died. What about SLP? A, B, and C is there. C died. C will get the assured value because C died. A and B's policy will continue. Clear? Any doubts still here? Now this is done. Then we have JLP accounting also. Okay. Before coming to JLP accounting, I'll discuss how it affects retirement. Now retirement is happening. Okay. Now we have 3 partners A, B, C. A's coverage is 2 lakhs, B's coverage is 2 lakhs, C's coverage is 1 lakh. Okay. Now retirement is happening. No one is dying. I thought no one is dying because retirement. Okay. Now tell me. Now say suppose their profit ratio is around 1:1. Okay. Now B is getting retired. Okay. Now since B is getting retired, he should get his share of joint life policy because he has paid so much premium. He should get his share. So how much will I give while retiring? Say suppose this is not JLP, this is the self. A has a cover of 2 lakh, B has a cover of 2 lakh, C has a cover of 1 lakh. Now B is retiring. I have to give B share of joint life policy because he has paid premium. What to do? How much will I give according to you?
He will get his share of that amount, and the remaining they will now only value and distribute for it.
Others?
SLP on like for example,
So, ನಾವು ಕಂಟಿನ್ಯೂ ಆಗುತ್ತೆ ಮಿಕ್ಕಿದೊಳ್ದವ್ರದ್ದು ಹಾಗೆ
ಅವ್ನು ಕಂಟಿನ್ಯೂ ಆಗುತ್ತಾ?
ರಿಟೈರ್ ಆಗ್ತದೆ ತಗೊಂತಾನೆ ಮಿಕ್ಕಿದ ಬಿಡೋದು ಕಂಟಿನ್ಯೂ.
See what will happen, no? See 2 plus 2 plus 1, we don't in SLP or JLP. Okay, JLP is another clear. Okay, before coming to SLP, let's discuss JLP. JLP cover has 5 lakhs. What will we do? Now retirement is happening, A, B and C, 1:1:1 is the profit sharing ratio. 5 lakhs is a joint life fund. Now what will we do? PSR. So will I get entire 5 lakhs? No. Say suppose surrender is 4 lakhs. Okay. How much will we get? 4 lakhs into his share is 1/3. So he'll get this much amount, whatever. 1,33,333 rupees is what B gets in JLP concept, which is very clear. In SLP also, we don't consider anything individually. We don't care. How much he has, how much he got, all that I do. We don't care. Okay, what we'll do is, and also it is retirement. This guy also will get only surrender value. He will not get assured value. Very clear. Huh? So what I'll do is, I'll take the surrender value of all the policies as on the date of retirement. Say suppose the surrender value of this is 1 lakh. Surrender value of this is 1 lakh. Surrender value of this is 50,000. Okay, this is surrender value. What I'll do is, I don't consider it individually or not. Even though it is SLP, I don't consider individually. I'll take it all. 1 lakh plus 1 lakh plus 0.5. How much is total surrender value?
0.5.
And take it togetherly and then share into how much is this guy share? This is what will give to B. Okay. And here money will be realized with respect to B only. Because that guy retired, policy broke, we would have got surrender value. A and B we have not got surrender value, but we have considered surrender value only for apportionment. Because why? A and B will get their money at later stage, no? So that apportionment is happening today only. Now one question. So it is a separate life policy. 2 lakh, 2 lakh, 1 lakh. Then why are they combining it and doing like this? They could have given 2 lakhs to B, 2 lakhs to A and 1 lakh to C, no? Or whatever. 1 lakh to A, 1 lakh to B. Exactly. If you see, the premium amount is borne in PSR only. Because separate life policies only. But the entire premium will go to P&L and that P&L expense will be shared in PSR 1:1:2. When the expense is borne in 1:1:1, then even the receipts from JLP or SLP should also be borne in PSR. That's why what we are doing, we don't care if it is SLP. We'll add all the surrender value and divide it in PSR and we'll give this much, whatever, 2.5 into 1/3 to B in case of retirement. Clear? Now same example, say suppose death is happening. Death. What will happen here?
Assured.
And we are talking about SLP. Oh, okay, first we talk about JLP. JLP 5 lakh rupees was assured value, 4 lakh is surrender value. Now one guy died. How much will we get? 5 lakh rupees, and 5 lakh rupees will be shared among 3 partners. 5 lakh into 3. That's all. JLP is clear. SLP? Only that percent assured value will get, which is 2 lakh. With respect to A and C, we consider their surrender values only. Why are we considering surrender values of A and C? Because they have not died, they have not got the money, but later they'll get. Later when they'll get B share also. So that adjustment we are doing today only. So 2 lakh plus A is 1 lakh plus C, 50,000. So total is 3.5 lakhs. Out of the 3.5 lakhs into 1/3, I will give it to B. This is in case of death of partner. Very clear? Only in death we'll get assured value. In retirement, we are doing only surrender value. Clear about it? This is about how JLP or SLP gets apportioned during retirement or death. Next, we have one more concept called as JLP accounting. How to account this JLP in the books of account. There are 3 methods. I hope you remember. One is normal premium method. I mean, you're paying premium every year. You'll book that expense. Entry will be premium you're paying. JLP premium account debit to bank account. They're normally paying premium. That's all. Whenever you get the money, you book it as income. So whenever you're paying premium, JLP premium account debit to bank. Simple. First method easy. Where will this premium go later? To P&L because it's a expense. Second method is called JLP asset method. Here what we are doing, whenever I'm paying money, say suppose premium is 10,000 every year. Okay. Entry will be JLP asset account debit to bank account. That is 10k. 10k. Here it is not an expense account. Here it is a asset. Okay, whenever I'm paying premium, I'm debiting asset, crediting bank. And at the end of there, what will I do? I see surrender value. Will surrender value be 10k only? No, I have always told surrender value is a little lesser than, I mean, whatever premium you would have paid. Correct. Now, say suppose surrender value is 8k. At the end of there, what will I do is I'll bring the asset to surrender value. Because right now, with this entry, JLP asset will be appearing at 10k. I don't want that to happen. I want it to be shown at 8k. So I'll decrease asset by 2000. I'll charge it to where? P&L. So what will I do? I have to decrease it by 2k. So P&L debit 2k. To what is decreasing? JLP asset. Set 2k. Clear? Every year we are doing this. Second year again you will pay JLP asset account debit to bank. Again you will compare it with surrender value. Difference will charge it to P&L. This is your JLP asset method. Third we have, that is JLP reserve method. Here what we are doing, same thing. Whenever you are paying premium, you will do JLP asset to bank only. At the same time, the moment you pay premium, on the opposite side, how much ever you paid premium, no, that much money from P&L or free reserve, you will transfer it to JLP reserve. This entry remains same. Next, what will you do? From P&L account, you will transfer same amount to JLP reserve. The entry will be debit to reserve account. Okay, how much? It will be 10k, 10k. Same thing. Along with this, you are doing one more entry. And in the end, you will compare your JLP asset. We still have JLP asset here. You will compare it with surrender value. Surrender value is 8,000. Now you have to decrease your JLP asset by 2,000. So you will credit JLP asset by 2k. Now what will you debit? Now no need to debit P&L because you have your own reserve. So debit reserve. So JLP reserve. Now how will this be appearing in your balance sheet? JLP asset will be appearing at 8k and JLP reserve also will be appearing at 8k. Clear?
So
now
P&L 10k will go.
From P&L 10k will go. Yeah. Okay.
So then what's the use?
It's a very big discussion. We can, but it's a very big discussion. The thing is, see, whenever you receive JLP money, okay, I'll try to keep it short. Whenever you receive JLP money, say suppose you are following second method, assume third method is not there. When you receive JLP money, what will be the entry? See, your JLP asset will be appearing at what value? Surrender value. Say suppose you surrendered the policy, you would have got surrendered value only. Entries, bank account debit to bank account to JLP asset account. Okay, now whatever was there in the JLP asset now went to bank. Now it is in balance sheet. Whatever money is there is now in balance sheet only. Earlier also it was in balance sheet. Now it has become money. It has come in bank account. Now whatever is there in balance sheet, that belongs to partners in which ratio technically? You think about it. I'm talking about the net assets. See, profit sharing is PSR. Here, something is there in balance sheet. If something is there in balance sheet, that belongs to partners in which ratio? Capital ratio. That's why in Garner versus Murray and all, we end up bringing capital because there no more profit sharing is happening. Because business is gone, you are dissolving the firm. So no more profit sharing is there. You are sharing the assets that you have. Now assets will belong to partners in their capital ratio. So what happens? You have incurred premium in PSR and you end up getting the JLP in capital ratio, which is wrong. Okay. So in JLP reserve, what will happen is here you are doing the same JLP asset thing. At the same time, you also have some money from P&L which has gone to JLP reserve. Once you get back the money, now what will happen? From JLP asset account, money will go to bank. What will happen to JLP reserve? Think about it. JLP reserve will be shared in the PSR ratio among partners, because of which their capital will be proportionately increased in PSR. Okay, their capital accounts only increase to the extent of JLP in PSR. So ultimately, they end up getting the JLP, which is in the asset side in PSR. Okay, no need to think about it much, but did you get the idea? Yeah, that is the idea.
So the second method is wrong.
Not wrong. Third method is better. That's
Better presentation.
better presentation. That's second method. If you go very deep, anything is happening. But third is better presentation. Okay. First of all, they have allotted 24 hours. What was I telling? We were doing JLP. JLP reserve method. That we are done. Now, when you receive the money, what is the accounting in the first method? Bank account to whatever came is income. Bank account to income account. Second, the second asset method, what will happen? Bank account to asset account whenever you receive. What if you receive over and above surrender value? If you receive assured value, surrender is 8, assured is 10. Say suppose one of the partner died and you are getting assured value in the JLP. So what will be the entry? Bank account 10 lakhs. To JLP asset we have only 8 lakhs. To JLP asset account 8 lakhs. To whatever came, that will be shared among the partners in PSR. Now with respect to that we don't have problem. The only problem is to the extent of JLP asset. And how much will be there in JLP reserve? Whatever is there in JLP asset. So to that extent we'll do that PSR allocation. Whatever is coming over and above JLP asset, no problem, because however we are allocating it in PSR ratio. Correct? If something comes over and above JLP asset, it will be apportioned in PSR ratio. Clear? In the second method. Third method also, same thing. Say suppose you have JLP asset, which is at 8 lakhs, you got 10 lakhs. What will you do? Bank account 10 to JLP asset 8, to remaining 2 lakhs will be apportioned in PSR. Directly will be sent to capital. But in third method, we have one more account pending. What is this?
Reserves.
This, what will we do? This JLP reserve also will clear off by sending it to partners' capital in their PSR, because of which their capital increases and they'll get right proportion in the JLP asset. Clear? Then this is about JLP accounting. Now we'll continue with the problem. And also one more thing which I forgot to tell you before going to this question. Yesterday we were doing one problem in the last. That problem, with respect to that problem, at one point we had that problem. You remember, the problem was that reserves, when we were doing the reserve sharing, to reserve opening balance, which was 30,000, we added profit till date. I was about to do profit till date, and then we realized that in the answer they have not done that. Now when I think about it, that is correct. I'll tell you why. You shouldn't add. Why? Because. Why is it? Because if you come back to this thing, see here, this was the profit, 167. See, out of this profit, did we transfer anything to reserve?
Not profit, sir. It is average. We calculate.
Ananda,
Profit.
is this?
Yes, sir.
It's average profit. Okay. See, average profit. Okay. In this average profit, 7 by 12 I did because up till the date of death. Did I transfer anything to reserve? If I have not transferred anything to reserve, that means entire profit I have divided. If I have not transferred only anything to reserve, why will I add it to the reserve? That was the problem. Since you have, see, entire 61, 67, we divided it off between A and B in that ratio, 4:3.
3 was.
Huh?
3 was on that.
4:3. That guy is 4, this guy is 3. Okay, entirely 61, 67. Did we transfer anything to reserve? Then how can we add it there? So that one thing we missed yesterday. So what they have done is correct. Because here we didn't. If we had transferred here to reserve, then that calculation would have made sense. Understood? Huh? Those who remember yesterday's this thing, that one thing we had started. So it's correct only. Understood? No? We were doing this question. We were doing one retirement question. JLP came, that's why we started discussing about JLP. Now here, JLP of the partners surrendered and cash obtained 18,875. So in revaluation, which side will this come? So see here, which accounting are they following? Are they which in the JLP accounting, are they following method 1 or 2 or 3? See, if you see in their balance sheet, they don't have JLP asset account. That means they are following first method. So whenever you receive money from JLP, what will you do? Consider it as income. So in revaluation account, it comes in credit side. Simple. Will come in credit side. Next, goodwill of the entire firm is valued at 35,000, and P's share of the goodwill is adjusted in the accounts of Q1, that is what we'll do even if they are not told. Who would share the future profits equally? New profit sharing ratio, they are given 1:1. No goodwill account being raised, even if they had not told you or not. Total capital of the firm is to be same as before retirement, and individual capital is in the PSR. This will do. Same thing, like how we did in one of the yesterday's. Amount due to Mr. P is to be settled on the following payment. Since Mr. P is getting retired, we have to give him 50% in cash the moment he retires, and 50% will do it in next year. That means it will go to loan. We have to prepare evaluation, capital accounts, cash account, and balance sheet. 4 things. So, shall we start? So first,
should we adjust here also? You will correct because
here they have not told anything. No, here you do bank. When nothing is given, assumption is bank. That means if there is excess capital, they have withdrawn, which is the correct assumption. Excess capital is there, they would have withdrawn. Deficit is there, they would have put. Here, don't go to current account. Only if they have told, do it. Now, shall we do revaluation account? Fatafat. So, revaluation account. Land and building appreciated by 20%. So, it is September 25, I think. You are open. Hey, no, I don't want to damn that. What I am writing exam. No, open it. Let me do this thing. You guys do revaluation account, let me know the profit. However, revaluation is chill. Why should I do it? I'll do it from partners capital. Question number 12. I'm done with my exam. No more doing.
so loss of 2005.
Losses?
2005.
But revaluation loss. No doubt. Profit, but you told loss. Something you have left chitta. Do you consider JLP and all? You have not considered something else. Something bigger only you have not considered. I think land and building appreciation you have not considered.
Profit of 88.
No. No. How come you are making mistake in revaluation account?
17,500.
Okay. It is 17,500. So 17,500 will be shared among the old partners in their old ratio. What is their old ratio? 2 is to, which is 2:3. 3:2. Correct, no? So dividing 2:3:2 ratio. So it comes to around 5,000, 7,500. Correct. It is creditors return back. That means your liability is increasing. Return back. Return off. Return back. Now, back then we had written off, now it has come back. So we have to write it back. That guy is asking now.
17.5.
It is 17 fine. Return back. They have considered in credit side only. What is it told? Old credit back. Hey guys, it's not return back. Then make it return off. Okay. As per the solution, I'm changing it. Return back is something which increases the creditors. It's written off.
It's coming credit side.
It's coming credit side. Andre, if it is written off, it will come in credit side. Technically, return back should come in debit side only, but in the answer they have considered it. Huh? Which is correct only. If they have told return back, putting it in debit side is only correct. But in the answer, I think it's a mistake. Yeah. They have done it like that only. They did not consider it as return back. In Josh, they have put it in the credit side only. They have got the answer. So, but return back means coming back. See, in the word only it is there. Return off is going away. Credit side ತಗೊಂಡ್ರೆ 17. 5,000 double effect ಆಗಿ 10,000. Okay, guys, it's written off. Okay, change it in the question. Return back, you do that only. There, double effect. Now, let's start with partners capital account. It is P, Q, R. It is P, Q, R. Okay. Come on, balance got down. 50,000. Any reserve that we have? No reserve. Then revaluation profit. 5,000. 7,500. 5,000. Then we have to do with goodwill. So I've told whenever goodwill is there, I'll first calculate sacrifice ratio or gain ratio, whatever. Old ratio minus new ratio. We have P, Q, R. What was P's old ratio? So 2:7. New ratio, they have told equally, which is 1/2.
1:1,
1:3 ಎಲ್ಲ ಇಲ್ಲ. P retired. So it is 0. Q 3/7 minus this guy is 1/2. This is 2/7 minus. See, you can ask, it is retirement. Why am I calculating sacrifice ratio? It's okay. If I get it in negative, it's gain only. No? So you better what you do GR only. NR minus OR. So 2/7 minus new ratio is again 1/2. So what has happened? This guy has sacrificed 2/7 here. 6 minus 7 minus 1/14. Here also it should be 4 minus 7. It is minus 3/14. So into 2 into 2, 4/14. So is it matching?
Yes.
Just to see if you have done the correct calculation correctly, how to check? Your sacrifice should be equal to gain. So gain is 4/14. Sacrifice is 4/14. Someone is sacrificed, someone has gained. Equal amount, correct. You have done it correctly. So what is my gain ratio? 1:3 is my gain ratio. Correct. Now, what is the goodwill apportionment? It is always gaining partners account debit to sacrificing. Who was gaining partners? Q scab or scab to P scab. So how much is the goodwill? They haven't given.
35,000.
That is total goodwill. How much is P share? How much is
8750.
into 2/7, which is 8750. This 8750 will be shared.
10,000.
It is 10,000. This 10,000 will be shared among Q and R in 1:3 ratio. Like that also you can do, or what you can do is 10,000 into 1/14 you can directly do. You'll get the same amount. How much? 2,500. Here?
7,500.
That's all. So this is the goodwill. Same thing. Both are same. Now we'll do this here. To Q and PR, the Q and R is debited. So to
By
P's cap. How much?
10,000.
Kerala.
2,500.
Q ಮತ್ತೆ 7,500.
7,500.
7,500. Here by
2.5.
Q's cap by R's cap. It is 2,500 and 7,500. Done with the goodwill adjustment. Anything else?
Profit.
Profit till the
Revaluation profit.
huh?
It's done.
Revaluation profit is done. Goodwill is done. That's all. We have this capital adjustment. Rest all is done.
Loan. Repay.
We have loan.
50%
Repay is there. Other than that, repay will do no. Other than that, that's all. Okay.
What about your joint?
We took it in revaluation. No?
You only need to distribute.
Distributed. It went to revaluation. In revaluation, it is shared in PSR. Automatically gone. Correct? Huh? Next. To P, what they have told 50% loan, 50% cash. So we'll pay off P. How much we have to pay off P? We have to pay. Out of that, I'll transfer half of to P's loan, which is 32,500. Remaining I will pay off. Done with P. Q and R they are telling one more thing they have to. The total capital of the firm is to be same as before retirement. So how much was the total capital before retirement? 50, 75, 50. 1 lakh. It was 1,75,000. Now they are telling even now the capital should be this much only. And in the PSR, the PSR is 1:1. So divide 87,500, 87,500. So 2 balance carried down. This is 87,500. Now you see any excess or deficit that will be withdrawn on this.
5,000
Barbeka, andre that will be bought by them. So by B sala, bank they'll bring it. No, P is gone. Q will bring how much?
32,500.
He will bring.
32,500.
No, we still have 2,500 here.
7,500.
7,000. They're saying 40,000. So this much they will bring. If nothing is told by doing this capital adjustment, that is bringing capital to PSR. If nothing is told, what will you do? Whatever excess deficit is there, you touch bank or cash account. Okay. Don't do that current account alone. Only if they have told to it, like how we did in the yesterday's problem. So we are done with partners capital. Then what there was? Cash account. Here only we good. Cash account. So opening balance.
7,500.
Then where did we get cash?
Repayment.
Then only hearing repayment we have paid 32,500 by P's cap 32,500. Then we have received money from partners, which is 7,500 plus 40,000. 2 Q's cap, 2 R's cap, 7,500. Then 40,000. That's all. 40,000. Then any cash that we received. Joint life policy I got no. So bank to income equity. So to revaluation account. 8. That's all. So all the cash. How much balance do we have?
51,370.
So it should be 51,370.
Sir, this bit written off that you have creditors written off.
written off. Wait, there is no cash movement. No, that there was a balance of 5,000, which I have no need to pay. I have no need to pay that 5,000. 5,000 liability was there. Now, no need for me to pay it. Is there any cash outlay? No. Why will it come in cash? Written off. The guy is not asking me the balance. He's like, okay, don't give me. Go. So I'm writing off that balance from my books. It is a decrease in liability. For me, it's an income because that guy is no more asking me. No cash movement is happening. Yeah.
So in cash account, we should first bring the JLP money and then we should transfer the revaluation.
Huh? No, directly take it to revaluation.
The entry will come in cash account.
Hey, what is the entry done? Bank account to revaluation account.
JLP
We don't have no asset here.
income account.
See, I tell you, whenever during revaluation, if you have some income, no, it will not go to P&L. It will directly come to revaluation. Now, whenever reconstitution is happening, revaluation is the new P&L. Okay, money is directly come to revaluation. So, bank account debit to revaluation will be the end. In revaluation, credit side. In bank account, debit side. Normal ledger. Okay, again, it will not go to P&L. Once it comes to revaluation, done. Or if it once goes to P&L, then it cannot come to. See, you can also do that approach. You can recognize there as income, but don't put it here. Adjustment will be same one. Because again, that profit will be shared in which ratio?
Yes.
Yes. So, accounting wise, both are same. If you bring it to revaluation, don't take it to P&L again. Clear? Now, this is one more very important thing. When revaluation is happening, when reconstitution is happening, revaluation is the new P&L. Everything, whatever is given in the question, okay, appreciation, depreciation, whatever, everything will come. PDD. See, PDD technically should go where? But why are we putting in revaluation? Because revaluation is a new P&L during reconstitution. Okay. Then what we have to do? Balance sheet. Balance sheet and all is okay, man. What are assets?
Land and building.
We'll do it roughly. Capital. Okay. Land and building. We have appreciated values, no? Tell me that.
75,000 plus 15,000.
So it should be 90. Then we have plant and machinery, which was 50.
Minus 50,000.
That is 35,000. Then
Stock is 25.
stock has become 25 after evaluation, no? Okay. Then debtors 25. But we have PDD
26.
1375, which comes to 26. 125. Then cash and bank was 51 375. Just now it is. Then capital. Q's capital is 87 500. R's capital is 87 500. P's loan
32 500.
32 500. Then creditors. Creditors how much?
25,000.
20,000. 25 minus 5 written off. So it is 20. So 227 500. 227 500. So done. Huh? 227 500. Balance sheet total. This comes to 1,75,000. Correct. So then debt. Okay, next RTP, what do we have? Okay, we have one more RTP question. We'll just discuss this RTP. Okay, this you go in home and try. We'll discuss the adjustments. You try it in home. Okay, it's a Acme and Co. is a partnership firm with partners Mr. X, Y, and Z, sharing profits and loss in the ratio 10:6:4. Okay. So we have capitals, we have reserves. So this should be distributed. Okay. Then it was mutually agreed that Mr. Y will retire from partnership, and in his place, Mr. P will be admitted as a partner. Here both is happening with an effect from 1st April 2024. See, whenever this one more thing, whenever 2 or 3 things happening in the same question, sometimes what will happen? Admission, retirement, admission is happening together. Sometimes admission, change in PSR is happening together. Like whenever there is two things of reconstitution is involved, what you have to do is you should be very careful during this goodwill allocation. Okay. So if one or more things has happened, two or more things has happened, what you do is don't think about anything. Directly while goodwill allocation, go to SR calculation. Don't think about anything. Take SR is equal to old ratio minus new ratio. Take all the partners, new, old, LR. If say suppose PQR, new partner is this. Take that guy also. Do this old OR minus new R properly. See who has gained, who has sacrificed ultimately. Because two effects will be there now in the sacrifice and gain. One will be for admission, one more will be for change in PSR. Correct? You doing it separately will psych your brain and all. Again, no need to do that. Consider it together. Now, this when you do OR minus NR together, you'll get the who has ultimately sacrificed, who has ultimately gained. Divide goodwill in that ratio. Why? Because even in change in PSR, you need goodwill. The guy should give goodwill. Even in retirement, the guy should give goodwill. Even in admission, the guy should give goodwill. So let's combine it now. Take the combined effect. Okay. Here we have combined. So we'll see the goodwill part. Okay. I'll tell you what I'm meaning. Goodwill is to be valued at 3 lakhs. Buildings and plant and machinery, everything, all this are revaluation. For revaluation purposes, you'll do it. Investments are to be taken over by the retiring partner at 45,000. What will you do about this? See, if you see here, right now the investment value is 36, but he is taken over at 45. See, first thing is, ultimately to the retiring partner, we have to pay money. But here, we are paying via asset, which is investment. So in partner's capital account, while repaying, via investment, shall give 45,000. So two investments shall do 45,000 in the partner's capital. Because instead of doing two bank, I'm doing two investments. My asset is going. One more thing, what you have to do with respect to this. Yeah, 36 worth book value has gone for 45. That means increasing 9,000. First, you have to show this in revaluation as 9,000 profit. Then do everything else. Then in the reconstituted firm, the total capital will be 6 lakhs. Here they have only told, no need to think about it. That should be in PSR. So divide 6 lakh in PSR, 2:1. Put it as balance carried down. Any excess or deficit, use cash, unless they have told anything else. See the surplus funds, if any, will be used for repaying bank overdraft. So surplus funds are the surplus funds of the firm. If you see, they have a bank overdraft of 1,32,000. So first, when you have money as a firm, we are not talking about this partner. When the firm has a surplus fund, first it will be used for repaying the bank overdraft. Then the amount due to retiring partners will be transferred to his loan. So retiring partner, we are not paying a single rupee except for investments. 45 we have paid by investments. Whatever remaining will be there now. That will transfer into loan account. No separate adjustment to do about it. It will automatically be adjusted if you see. Okay. No, nothing. You just give money to bank overdraft. You ensure that you are paying off bank overdraft. Everything will be in place. No other adjustment to do for this one. Okay. So that's all. We have to prepare evaluation, capital, bank account, and balance sheet. So only one thing I tell is goodwill adjustment. Okay. I want to tell you. So whenever goodwill adjustment comes, what you have to do? SR. OR minus NR. Okay. Who are the partners we have? X, Y, Z. X, Y, Z, and new partner P. Take all of them, including admission. Who is retiring? Y. So X is old ratio is 10 by 20. Correct? Y 6 by 20 and Z 4 by 20. This guy doesn't have anything. New ratio 2:1. See, here it also has the effect of change in profit ratio also. So three things are there. You should not worry about it. You do one lekha at a full. Okay, what is ultimate old ratio, ultimate new ratio? If you take, everything will be
2 by 5.
Now this guy will be 2 by 5. This is 0. 2 by 5.
1 by 5.
Ultimately, you do this. 1 by 5. Ultimately, you do this. Now you see this guy into 4 into 4, and then 2 by 20. Idu 6 by 20. Idu into 4 into 4, 8. So minus into 4 into 4 minus 8 by 20. Idu
minus
minus 1 by 5. And the denominator same what minus
4 by 20.
minus 4 by 20. Now have you done everything correctly? See, it should match if you have done everything correctly. Something is wrong. See, into 4 into 4. 4 to the 8, 10 minus 8 2, correct. Here it should be 6 by 20, which is correct here. Into 4 into 4, 4 to the 8 minus 8 minus 4 by 20. Okay. Now is it matching? Yes. 6 plus 2, 8 by 20. If it is in positive figure, what it is? Sacrifice, sacrifice. Sacrifice, total sacrifice is equal to total gain. 8 by 20, 8 by 20. That means our lekka is correct. Okay. Now what you have to do? Simple. In goodwill, always the logic is, what is the logic? Gaining to sacrifice. So are gaining partners. Those who are there in negative. So Z cap,
P cap.
P is cap to
X cap.
X cap to Y cap. Now how to decide the amount? Take the total goodwill. How much is the goodwill? 3 lakh into 2 by 20. How much? I tell you.
30,000.
Put it here. 3 lakh into 6 by 20.
90,000.
Okay. Then 3 lakh into 4 by 20.
60,000.
3 lakh into 4 by 20.
60,000.
Why take it? Takes so simple.
ಅವ್ರು ಶೇರ್ ತಗೊಂಡ್ರೆ ಹೆಂಗೆ ಮಾಡೋದು?
ಏನೇನು?
ಅವ್ರದ್ದು ಡಿವೈಡ್ ಮಾಡ್ತಿದ್ದಾರೆ ಅವ್ರ ಕ್ಯಾಪ್
ಮಾಡೋಂಗಿಲ್ಲ. ಗೇನ್ ದೇಶದಲ್ಲಿ ಏನ್ ಬೇಕಾಗಿಲ್ಲ. ಡೈರೆಕ್ಟ್ಲಿ ಟೇಕ್ ದಿಸ್. ಇಫ್ ಯು ಟೇಕ್ ದಿಸ್ ಆಲ್ಸೋ ಸೇಮ್ ಆನ್ಸರ್. You are dividing it that ratio only now. Directly take that share only instead. Simple. So 3 things have happened. You don't worry. You do one calculation. Take the ultimate old ratio, the ultimate new ratio, right? The latest ratio. Which is the latest ratio here? 2 is to 2 is to 1. Clear? Simple. Done. So
So
remaining.
what if in adjustment they have not given new ratio, they have just admitted like he brought the capital and log 1/3 is
Calculate the new ratio. You can calculate. No? Assume SR to be OR. New share is already there. Find out the new ratio and do it. To do this math. Correct? Huh? All of you understood our question. Now she's telling what if they have not given new ratio, but they have only given the new partner share. What will you do? Yeah, you can find out new PSR and do the same math. Okay. So we are done. Remaining, you have to do it in home. Okay. We'll see what if they're in. Then we'll do death of a partner. Okay. One question. We have it in September 25 RTP only. In death, what will happen is death is as good as retirement. Only difference is retirement from the world. For us, the calculation are the same. Okay. Exactly like retirement. Only one thing extra that we have here is one thing is with respect to JLP SLP, it changes later. Assured value is coming into picture. In case of JLP, in SLP, assured value of only the dying partner will get. Other partners will consider surrender value only. Correct? All of you? That is one thing. And second thing, what it changes is we have to give the profit till the date of death. How will we calculate this? Mostly in question, they'll ask you to calculate this based on the average profits of previous years. So you'll calculate the average profit. Okay. Then you'll consider in current year till the date of death. And the time you have to divide it till that month and give it in his profit sharing ratio. Clear? And by doing this, what is the entry past? Okay, I calculated the profit. Now I have to give it to the partner. Say suppose partner is B. So I have to credit his capital by B. To B's capital. Debit what? See, you cannot do P&L because P&L account is not prepared only in the mid of the. So what I'll do is P&L suspense account. Okay. Even if you do P&L account, nothing wrong. Okay. It is P&L suspense. This P&L suspense is the nature of assets. So until P&L is prepared, it will be appearing as assets. Once the final P&L is prepared, P&L suspense will be knocked off with P&L account. Okay. Now what will happen? The P&L contains full profit, the share of profit including the retiring partner share. When P&L suspense knocks off P&L account, his share is gone. Only remaining profit will be there. That will be shared among remaining partners. Understanding it? P&L has a P&L suspense account has a debit balance. So credited and debit P&L, which has a credit balance. So Debit P&L account, credit P&L suspense. Clear? That one thing will happen. So whenever you are giving the profit, the entry is P&L suspense account debit to retiring partners capital account. Done. No? So only that two things changes. Rest all is as good as retirement loan. So we'll see this question. The partnership deed of a firm consisting of three partners, alpha, beta, gamma, PSR is 2:1:1, whose fixed capitals are
96.
the partners are allowed interest at 8% on their fixed capitals, but no interest is to be allowed on undrawn profits or charge. So no interest on drawings. That upon the death of a partner, the goodwill of the firm be valued at 2 years purchase of the average profit after charging IUC for the 3 years to 31st December preceding the death of the partner. So when his death has happened? Here, 30th September. So which is the December preceding this date? That is 31st December 2023. So what they have told, average net profit for the 3 years to 31st December preceding the death of a partner. Andre 3 December that you have to take, which is preceding the death of the partner. Death of the partner has happened when? So the December preceding this is 31st December 23. So you have to take 23 December, 22 December, 21 December. So here, you have to take 23, 22, 21. This three you have to take for calculation. Okay. Then insurance, 75,000 each was taken in individual names of each partner. They have taken SLP. The premium was charged against the profits of the firm, of course. The surrender value of the policy was 20% of the sum assured. Now what would have happened? 75 each is there. That means total 2,25,000 total. Okay. Out of that, one guy died, because of which you would have got 75 fully. With respect to the other two, they are still there. We consider surrender value, which is 20% of sum assured. Andre
15,000.
75 plus 75, 1,50,000. Two partners, 75,000 plus 75,000, 1,50,000 into 20%, which is
1,20,000.
8. It is 1,30,000. So it is total 105K will take into this guy's share is the partner who died. I told you, no, we'll consider everything together. We don't care whether it is SLP or JLP. I took it together. One of the partner died, that's why I'm taking 75K. The sum assured. The other two partners, they have not died, I'm taking assured sum
21,000.
So this guy's share was 21. Huh? How much was PSR? 2:1:1. Under 1/4. If you do 1/4, you're getting 21K. Huh?
26.
How much?
26,000.
It should come to 26,250. So this much will go with respect to policy. Upon death of the partner, he is to be credited with his share of profits IOC calculated up to 31st December following his death. That is very important. When did he die?
31st of September.
But they are telling they want interest on capital. Generally, what will we do for share of profit or interest on capital? We'll calculate it till the date of death. But here, what did they tell? Calculated up to 31st December following his death. Now, which is the December which is following his death? September 24 he died. The December following his death is 31st December 24. That means you have to calculate IOC. You have to calculate share of profit till the December for the entire year. Okay, that is the biscuit here. Done. It's closed now 31st December. This guy died on 30th December 24. The amount standing to his credit of his current account is 15,000. And from the date to the date of death, he had withdrawn 90,000. So this is drawings. This is current account. What will you do for current account? Current account is as good as capital account. So what you do? Transfer it off to, however we are settling his account. Transfer the current account to capital account. And whatever drawings is there, show that also in capital account. Because how will drawings come? Where will drawings come? In capital account only. So it come in the debit side of the capital. Capital account debit to bank, something like that. So show 90,000 there and 15,000 transfer it to capital account. Done. Next. Unrecorded liability 18,000. What will you do? Will come in revaluation which side? Debit side. Increase in liability. Now it will come in debit side. And we have paid it off immediately. That means in bank account also we have to consider. The trading results of the firm, all this okay. You are required to prepare an account showing the amount due to Alpha's legal heir as of 31st December. Okay. Impact for unrecorded liability not to be given in earlier years. They have only given. Understood? If unrecorded liability, we don't know from when it is there. We came to know that there was an unrecorded liability now. What if it is there from past 3 years or 4 years? I have not recorded. So now what will you do while considering this average profits? They have given the profits of previous years. No. Now some students think in that level that what if unrecorded liability was there from 2021? The effect of the profit should also increase here also. So all that problem will happen. So they are like, adella malbedi. Eshtiде eshtu madi. They have told. Because unrecorded liability, we don't know when it is, from when it was actually there. Okay. What if it is there from 2021? That problem will be there. So that's why don't do all that. Don't take that effect.
Not even in 2024.
Hey, in 2024 you take that. In revaluation and all you take. Previously, don't consider for these profits. What they are telling is, now you are using these profits for what?
Average.
Average. Now tell me, I'm just telling you, if unrecorded liability was there in 2022, then the profit 79,410, is it correct?
No.
Because you have not taken the effect of liability. If you take the effect of liability, credit liability, debit P&L, your profit will decrease by how much? 18,000. So your actual profit will be around 50 something. You are considering these profits for a future profit. And if you are considering wrong number, it will be a wrong profit. So what will students do? What if unrecorded liability was there before? So then minus it off from 2022, which is a correct assumption only. But they have not told anything about it now. Have they told it was there in 2022? Have they told? Nothing they have told. So that for better purposes, they are telling don't take that assumption. Because right now, if unrecorded liability was there in 2022, then 79,410 is not the right profit. Right profit is around 50 something. So they are telling don't do all that. Forget.
So if they're not given that amount, then how should we
Do it normally only because they have not told to which year unrecorded liability belongs. What will you assume? Simply I cannot assume 2023 there, 2022. Even if the note is not given, do it the same way. Assume unrecorded liability belongs to this year. That is a better assumption as compared to the others. Correct? I think we have the same problem in the book also. No, 100% we heard. Now I realized after reading everything. Maybe that note and all is not there, but the question is there. It's okay.
Yes, similar.
Similar one.
Fifth adjustment.
Huh?
Fifth adjustment.
The profit has been given last year.
For
Profit saying not particular. Minus mark.
Yes. You minus and do the average. The share of the partnership policy, fourth, up to 31st December. See, he is dying on when? 30th September. I would have given interest on capital till when? 30th September. Profit? 30th September. But here they have told you have to give it till 31st December following his death. Death yavagagiddu? 30th September 24. Which is the December following his death? Andre following andre after his death. Ella calculation allivargu madilla. For IOC, for share of profit. Okay, we'll do it off. Why take time? Okay.
So can you solve this question before that?
Why? Same thing only, Noda.
No, sir, it's similar but not same. It's more complicated.
Is it true? Page number?
Sir,
57.
last one.
This is a different question only altogether. Okay, then we'll.
Working out on the page.
Now what? All of you will do that question, or we'll do the RTPR. But that technically they would have already thought what to do. Even I'm confused. Okay, we'll cover this one question which we have already read. Okay, from the RTP. All of you come to that question. If all of you want that question to be solved, we'll do it. Majority wins. What? Now what do you want to do? Shall I solve this question, or shall I solve that crazy question? Okay, however, since this is there, and I hope you have understood this also. So we'll go to the crazy question only. This one you have to write it home. Okay, we'll do that. Yeah, man. But the thing is, see, in the revision time or not, it is so less. We cannot solve those questions also. So the best option is to solve RTP. At least for you guys, RTP once it will be covered, and we can explain the concepts. Okay, we'll do this question.
So they will give this joint rate policy calculations.
Yeah.
Final.
Yeah. Aram, why not? That depends, man. We have to see. Okay, we'll read this question. Okay, come on, guys. Peter, Paul, and Fritz were partners sharing profits and loss in the ratio 2:1:1, which is old ratio. It was provided in the partnership deed that in the event of retirement or death of a partner, he or his legal representatives would be paid what? First, the balance in the capital account, of course. Next, his share of goodwill of the firm valued at 2 years purchase of normal. So normal they have told, that means simple. They'll apply simple average profits. After charging interest on fixed capital, that means in the profits whatever they have given, you have to consider IOC also. For the last 3 years to the 31st December preceding the retirement or death. Now you know what this is. When did the death happen? 30th September 19, which is the December preceding the September 19? 18. So you have to take 18, 17, 16, 3 years. Then his share of profits from the beginning of the accounting year to the date of retirement of death, which shall be taken on proportionate basis of profits of the previous year as increased by. So you have to take previous average, correct? No, you have to take the previous year profits, not average. Literally take previous year profits, add 25% and assume that to be the current year profits for apportioning share of profit. Then interest on fixed capital at 10%, though payable to the partners, will not be payable in the year of death or retirement. So what they're telling, IOC is generally paid if nothing is told. That the partnership deed is telling in the year of death, okay, interest on fixed capital will not be paid. To whom? Only to the partner who has died. Okay, of course. Why will these partners give up? In the year of death, the partner who died will not be given interest on capital. It is not given in the question, but for your reference, you can note it down. Okay, only for the partner who is dying will not give. Other people will give. Huh?
Goodwill calculation considered. 10% goodwill calculation after charging interest on fixed capital.
ಅದು to ಇಲ್ಲ goodwill calculation. ಇಲ್ಲ his share of goodwill of the firm should be valued. So it's for this thing after charging interest on fixed capital is for valuation of goodwill. Correct? No? Next. Any done? No, till here any confusions? No. All the assets are to be revalued on the date of retirement or death, and the P&L to be credited to capital account. Guys, they have told revaluation profit should go to capital account. If nothing was told, you would have put it where? Here we are doing fixed capital method. So you would have put it to current account, but here they've clearly told put it to capital in the TSR. Okay. Peter died on 30th September 19. Books of accounts are closed on calendar year basis from 1st January to 31st December. The balance in fixed capital 10, 5, 5. Balance in current accounts 20, 10, 7. See, we have following fixed capital method. Drawings of Peter till 30th September 19 were 10,000. That we'll consider. The profits of the firm before charging, guys, here also interest on capital is not charged. Before charging IOC were 1 lakh, 1 lakh 20, 1 lakh 50. Profits include abnormal items of credit. Now these profits, what they have given, no, 1 lakh, 1 lakh 20, 1 lakh 50 includes abnormal items. They have only told both are abnormal items. Now tell me, why have they given me the profits of previous years? Either to calculate goodwill or to calculate a share of profit. Now I am using these 3 years previous profits to arrive at a current year number. I thought, in case of valuation of goodwill, why am I using previous year profit? So what am I telling is, if out of 3 years my average profit is 10,000, and I'll multiply it by number of years of purchase. When I'm multiplying it by number of years of purchase, what am I telling? See, 10,000 is my average profit. This I can maintain it for 3 years. So my goodwill is 10,000 into 3, 30,000. So don't you think this is the future profits, future maintainable profits for the purpose of goodwill? And for the purpose of share of profit, it should be current year profit. Now, in the first case, you're finding current year profit. In the other case, you're finding future maintainable profits. Do you think you should consider abnormal effect here? Why not? Guys, will abnormal loss or gains, will it happen every year? No. Only normal gains will happen every year. That is better to consider in the assumptions. Abnormal, now in 1 year, fire happened. But every year fire will happen. So is it? Now, say suppose previous year profit technically is 1 lakh. But in that year, fire happened and the loss is 1 lakh. So your profit is 0. What? You'll not make profit only? No. You'll not value goodwill only? Wrong, no. So abnormal effect they should not take. So here they have given us they are telling that this 1 lakh, 1 lakh 20, 1 lakh 50 includes the effect of abnormal. So this is what profit on sale of asset. It is abnormal gain. Every year will not have profit on sale of assets. Insurance claim received, every year you will not have insurance claim. Both are income. So these incomes you have to subtract from the profits while doing the goodwill calculation or share of profit calculation. Simple. Next, the firm has taken out a joint life policy for 1 lakh. JLP is 1 lakh. Besides, the partners had severally insured their life for 50,000 each. Guys, here we have both JLP and 3 SLP, 50,000 into 3. The premium in respect thereof being charged to P&L account. All the premium is going to P&L account. The surrender value of the policy is for 30% of the face value. Now tell me, in case of apportionment to Peter, what I will consider? JLP, the moment one of the partner died, entire money, assured value only will come. How much is assured value?
1 lakh.
1 lakh. And in respect to SLP, the partner who died, his share will come. His share is how much? With his share, assured value entirely will come, which is 2. But with respect to the other two partners, will not get. We have to take only surrender value. So 50 plus 50, 1 lakh. 1 lakh into 30%. This is the amount I'll use for apportionment. 1 lakh 80. Out of this, Peter's share is
90,000.
2 by 4. So 1 lakh 80 into 2 by 4 is 90,000. Out of policy, we'll give him 90,000. Simple. Next, on 30th June 19, all of you understood 150, 30. 1 lakh JLP entirely we got assured value. 50,000 from the SLP we got the assured value. Remaining 2, the other 2 partners we will consider, but we'll consider surrender value because they are alive and they'll get the money at a later date. So I've taken surrender value, done. Next. On 30th June 19, the firm received notice from the insurance company that the insurance premium in respect of fire policy had been undercharged to the extent of 6,000 in the year 2018. Now what is this? In 2018, we had paid insurance premium. Now they are telling that insurance premium, whatever we had paid, is less. The actual insurance premium we had to pay for that year was by 6,000 more. Say suppose if the insurance premium was 10,000, in 2018 they have charged only 4. Now they are telling no, sir, it was not 4, it is 6. If it is 4 plus 6, 10. They are undercharged the premium that year. The firm has to pay that immediately. The revaluation of the assets. Okay, we'll come back later. Now, what to do about this 6,000?
Evaluation.
You have to take it to
Evaluation.
revaluation account because we are paying it now. That is one thing there. Next. What about the previous year profits? See, if they have undercharged 6,000, that means is 2018 profit correct profit? No. Only after charging this 6,000, then it will become correct profit. So what I have to do in 18 also I have to subtract. Now one doubt you'll get. So in 18 also we are subtracting. In revaluation account also we are taking. Sir, how? Anyone has this doubt?
Yes.
We are repaying it, so we have to take it to evaluation.
Correct. Which we consider. Revaluation goes on, it's as good as it went to P&L only. Expenses book, that expense is shared also. Again, when taking previous year profits, you have to subtract, I'm telling you. So,
previous year outstanding, 2018 outstanding no payment.
outstanding already. Then you're telling that time it should not be considered. Anta. Or outstanding, that time it should be considered. Now it should not be again considered. We are considering it here in revaluation also. I'm telling in that profits calculation or goodwill calculation, from that profit you subtract also. Is it correct? Prima facie, when you listen about it, it's correct. It is, you're feeling it is wrong. But what I'm trying to do is divide it. There is accounting effect, there is number effect. Accounting effect is now since I'm paying 6,000, I'll put it in revaluation. Normal accounting effect. I have not recognized that expense. Now I'm recognizing in revaluation. Done. That is accounting effect. Why am I subtracting it from profits? Guys, again, with this profit, am I doing something accounting? What am I doing? I'm estimating future profits. For estimating future profits, I have to take true profit of 2018. What is the true profit of 2018? Though I'm not charging it to 2018, the true profit of 2018 is the profit after deducting insurance. No? Accounting effect I'm giving it now because I cannot go back and give. But when I'm taking those profits for calculation, I have to take true profits. So the actual fair profit as on 2018 is after considering the premium. Because 10,000 premium was a normal expense. So that's why for calculation I'm considering minus 6,000. I'm not doing any accounting effect there in minus 6,000. Accounting effect I've given here in revaluation. There also I'm subtracting because I want true profits for the calculation. Because I'm estimating something from those profits. Understanding the difference? That's why it's subtracted from there for the calculation. Clear? So done. Next what we have upward division of revaluation asset, which is up by 20,000. That will consider it in revaluation account. Now prepare the account showing the amounts due to Peter's legal representative as on that is. So we'll do it. So only we have to find out what all we have to give to Peter. They have asked Peter executor. To understand how much we have to give to executor, we should know how much is the capital balance that we have to give to Peter. So working note 1 is prepare Peter's capital account. But all the adjustment will, however, come in Peter's current account. So we have to put both. So how much is the Peter's capital balance?
10,000.
It should be by balance quantum 10,000. Now nothing will come to Peter's capital account except one thing, which is revaluation profit, because they have clearly told in the question. Next we have Peter's current account. Balance
20,000.
Okay. Now what will we first calculate? We calculate goodwill only. Okay. Valuation of.
So for that one, it is 90 correct profit.
Of course.
So why would it 20,000 into this?
Opening balance. Given in the question only. Okay. Now particulars. 3 years profits they are given. Which are the 3 years?
16, 17,
16. So profits.
1 lakh, 1 lakh 20, 1 lakh 50,
1 lakh, 1 lakh 20,
1 lakh 50.
1 lakh. But this is what? This includes abnormal profits also, and this is excluding interest on capitals. Interest on capital. So three things have to subtract. Abnormal items, two are there, and interest on capital. So minus. What are the abnormal items we have?
Profit and loss of
Profit on sale of assets, which is
5,000,
5,000, 7,000, 10,000. Then insurance claim, which should be 3,000, 0. Then we have interest on capital. I will come there. Interest on capital,
10%.
2,000, 2,000, 2,000. And from 2018, I'm subtracting 6,000. Why? Because I'm using these profits for valuation. In valuation, I want correct profits. So this 2018 actually pertained to, this premium actually pertained to 2018. So it should go to 2018 profits. Okay. So minus. No, premium undercharged. It is 6,000. So what is the actual profits?
90, 1 lakh 11, 1 lakh 20.
So it should be 90,000, 1 lakh 11,000 and
1 lakh 20,000.
so this is the three profits. We are valuing goodwill. They are, in question only they have told it is simple. So do simple. The average will be how much? 90 plus 1 lakh 11 plus 1 lakh 20. It is 3 lakh 21. 3 lakh 21 divided by 3 will be
1 lakh 70,000.
1 lakh 7,000. So goodwill will be 2 years purchase. So it should be 2 lakh. So done with goodwill calculation. This is firm's goodwill. We'll do Peter's share. Peter's share will be how much? His. But I don't prefer doing that. I want to do it like that only. Old age sacrifice is equal to old age because we don't know what other effect we have. Yeah, man. No, even if you do it like that, we'll get 2/4 only. But what I'm telling is, better you always calculate sacrificing ratio because if there is any other effect, you'll come to know. In this question, of course, we don't have any other effect. But if at all we have, we'll come to know. That's why I'm keeping it as a standard procedure.
Ratio is not given, so it will be the same.
Same. Here we don't have the effect, but always as a process. Why I'm telling is, if there is other aspects, you'll come to know. You'll not miss it out. 2 lakh 14. Done. Second, what you have to calculate? Share of profit. So share of profit.
Previous year, 1 lakh 50 for year 18.
So which 3 years will you take?
It's not
From
3
the
years.
question.
So only 1
1
year.
year. Last year plus 25%.
Sorry. It is last year. How much is last year
1
profit?
lakh 50.
For
1
year
lakh?
18.
1,50,000.
1,50,000. But this considers
Insurance premium and that's
that we take. The true profit of 2018 is,
Minus 6,000 is 1
so it will come to
1 lakh
1,44,000.
25.
They have told, now this is the true last year profit because 8,000. What have they told in the question? Yeah, but in the where is that share of profit from the beginning of the accounting year to the date of retirement, which shall be taken on proportionate basis of profits of previous year. So they have directly told the profits of previous year. So we'll keep the abnormal items, nothing will. In valuation of goodwill, it is about future maintainable profits. We removed it. Technically, if you ask me, okay. Now you have to go with the solution, okay. But if you ask me, they had to subtract abnormal. We have to subtract the abnormal because for current year we are estimating Will abnormal items repeat in the current year? So technically the right assumption will be to subtract the abnormal items also, but in the question they have not done that. In the answer for the profit they've kept it as previous year. They've literally taken previous year profits. Since this insurance premium belonged to 2018, that effect they have removed because it actually belonged to 2018. We are recording it now. So that we have removed. Abnormal, in my opinion, they have to remove it. In solution, they have not. So 144, increase it by,
25.
so it comes to,
36,000.
the total 1,18,000. Okay, and here if you come back again, they have told to the date of retirement, the previous year has increased by 25%. And if you see here, these profits are there, no? The profits which they have given here, 1 lakh, 1 lakh 20, 1 lakh 50. This is before charging interest on capital. Now we have to give interest on capital. No? How much interest on capital we give?
2,000,
How much is the total capital we have?
20,000.
Whose are you taking? No? Total capital of all the partners. 20. Yeah? Out of 20, in partnership deed we read one clause. In the year of death, that partner will not get interest on capital. Okay, that means exclude that partner's capital.
15.
10,000.
Out of 20, remove 10. So it is 10,000. 10,000 into 10% is. So we'll give only IOC. The actual profit that will be given is
79,000.
okay. Because IOC will give to other partners. Now IOC, all that will give, salary and all will give. You remember P&L appropriation. Once the profit is earned, we give salary, commission, we charge interest on drawings. Then we'll give interest on capital. Then the remaining profit will give it to the partners in their PFR. Correct? Huh? So that's why we have subtracted IOC. That is one of the appropriation items. So 1,79,000 to be considered, but this is whole year profit. Okay, they have also asked us to take whole year only, but we have to take only Peter's share. What is Peter's share?
2 by 4.
Don't you do time-based proportionate?
Yes, 9 months.
You want to do it? What have they told in the deed? They have told to calculate it till the following 31st December. The December following the date of the death, which is 31st December 24. Till then we have to calculate. So 1,79,000 into
2 by 4.
into 2 by 4. What nonsense, man. Where is that here? The share of profits.
To the date of it.
Oh, guys, it is to the date of retirement or death. Yes.
6 months.
It was only for interest on capital, I guess. Where was that point? Where did we read that? Oh, that was in that RTP question. Huh?
Yes.
Oh, it was in the RTP question. Okay. So this should be taken time based. So till the date of death we have
9 by
9 months. So into 9 by 12.
67 by 25.
So it will come to
so 1,34,250.
1,34,250 into this guy's share will be
2 by 6.
67.
125.
Now this is Peter's share. So that was there in the RTP. Okay. Share of profit is done. Then JLP. JLP we have already done now.
Yes.
What is it? 1 lakh
Plus 30,000.
plus
50
75.
Plus 30.
Hey, 1 lakh JLP you would have got.
80.
I thought. Then here 50,000. Then
1 lakh.
it is 1 lakh.
80.
Okay, Peter's share will be
90.
2 by 4.
into 2 by 4. This guy's share will be 90. Then what we have to calculate? JLP done. Revaluation we have to do. Revaluation how much? The total revaluation in assets is
20,000 and
20,000 and
increase 2 by 6,000.
okay that.
Under charge.
Okay, we'll do it here. Minor. So it's a payment. That means it will come in the debit side. 20,000 is profit. 6,000 is
Loss.
so
14,000.
it is.
14,000 and 7,000 is issued.
See what they have done in the question is, I'll tell you the difference. 6,000 they have considered separately as an effect, and they have decreased it from. What they have done is they have not passed it through revaluation. what they have done is, in P&L only they have subtracted his share of expense. And then how much? 6,000 into how much is Peter's share?
2 by 4.
This they have subtracted from capital. Both are same. If you want to do this method, we can do it. Both are same. How much? If you are doing this, then don't again consider there. So 14 into
2 by 4.
2 by 4 is. So this is his revaluation check. Next, what do you have? Goodwill done. Everything else is done. Insurance, share of life policy. Done. So we'll put it one by one. So in capital, revaluation will come. So by
Sir, for the profit in revaluation, why did you minus 60?
yeah, see, we are paying it now. No, it is like that unrecorded, not unrecorded liability. It's error of omission. And technically, see in revaluation, what will come? Revaluing of assets, increase in asset, increase in liability, decrease in asset, decrease in liability. Then what? Unrecorded liability, unrecorded assets. What is this case? The premium. Unrecorded. It is an error of omission. Not error of omission, it's an error from insurance company. If they had charged 10,000, I would have considered 10,000 in the last year. Mistake made by me. They have made. Now they have given me the expense. What can I do? It's a normal expense. So what you can do is, if you want to put it in revaluation, not a problem. The effect will be same. See what we have done in our question. We have directly taken 6,000. In that 6,000, we have taken Peter's share and we have put it in debit side. We have only apportioned that share of expense, which is still correct. I have put this in revaluation. Here also what will happen? That loss will be apportioned in PSR only. Both have the same effect. Okay, I'm doing the revaluation only. We'll get the same answer. Okay, no problem. If you want to directly put the expense in capital, no problem. All of it. Both are same. What is happening? Here, revaluation profit, revaluation loss getting shared in same ratio. Both are same effect. Okay. So by revaluation profit, 7,000. So balance from here it will be 270. Peter's executors account 70. Okay. Then current everything else will come here. First we have goodwill. What was the entry? Oh, we have not yet done this thing. No, we'll do that. Okay. Now what new rationale they have not given? Oh, they have not given. Then we have to calculate and all. Better we'll do it like that only.
So directly you can do it.
Yeah, directly. How much is the share that Peter is giving up?
2 by 4.
So the share sacrificed by Peter is 2 by 4. So how much goodwill will you give? 2 by 4. Okay, no. So 2 by 4 of the total firm's goodwill is 2,14,000 into 2 by 4. How much? 1,07,000 rupees. This much we will give it to that guy. So by who is the other gaining partners? Paul and I'm combining it because we did not do all that charge. Paul and Prince cap account 1,07,000. Then
Profit.
we have share of profit P&L suspense account. This is 67 125. Then we got JLP.
90,000.
So there are various things. So which account should come here? You have to think about it. So no, JLP. In case of JLP, what would have happened? We have entirely received that whole this thing. So by bank account debit to entirely. Hey, we don't have asset only now. Where do we have asset? They have not given enough information as to which accounting they are following also. So what we'll do is we'll write by JLP account, which is from JLP. How much did we give? We got 1 lakh. His share is
50,000.
His share is 50,000. In SLP,
We can combine and write it.
okay, but better no.
40.
Give it separate.
This
This
is
is
40.
in SLP. The total was how much? Exclude 1 lakh. We had
1 lakh
SLP
into
50
2 by
plus
30.
30, 80 by 2. This is 40. That is here. If you want to combine and write life insurance policy is 90, which is still okay. No problem. Then we give life policy also. Then
Drawings.
We have drawings, which will come and hit here only. And we have Peter's current account opening balance, which you have considered. Then drawings. Two drawings, how much?
10,000.
You come to 10,000. Anything else? Insurance premium undercharge, we have considered in revaluation account. That's all, guys. What is the balance?
Two lakh 74,120.
So it is 2 lakh
74,120.
70. You're getting 2 lakh 74. Okay. 2 lakh. Executor account. 2 lakh 74,000. So how much will ultimately go to executor? Peter's executor account. From current account, how much came?
2,74,120.
2,74,125. And Peter's capital account? 8 lakh. 19,000. So total? So how much you have got in Peter's executor's account is 2 lakh.
91,000.
Balance carried down 2 lakh 91,125. That is the answer. Okay. Now what we have done is we have considered 6,000 in revaluation. That's why we have this difference. If you consider it to be, if you directly apportionate 6,000 to capital account, then the numbers will be different. But this amount will be same in both the cases. Okay. This will differ because of the two different assumptions that we have made. Done now?
So current account.
ಏನ್ರಿ ಬೇರೆ ಬಂದಿದೆ ನಿಮಗೆ 2,71,125 ಬಂದಿರುತ್ತೆ ತಾನೆ.
Final answer 2,91,125 correct ಇದೆ.
ಹಾ.
Current account ಮಾಡಿಲ್ಲ.
ಕರೆಂಟ್ ಅಕೌಂಟ್
ಅದು ನೀವು
ಸಿ ಅದೇ ನಾನು ಹೇಳಿದ್ದು ಆ 6,000 ನಾವು 6,000 ಶೇರ್ into 2/4 ನ ಡೈರೆಕ್ಟ್ ಆಗಿ we have taken in current account in our case whatever we have solved. Okay, what I have done is I have directly taken that payment in revaluation account. What will happen in revaluation? Again, that expense will be shared in PSR only. What we have done there in the solution, we have shared it in PSR only, both same effect. Your capital current account will be different, but ultimate payable to executor is same. Okay, I told both is acceptable, but if you still ask me, the better presentation is still that only. Okay, transfer it to capital. Yeah, put it to capital only. But why I did it in revaluation? Because I just wanted to show you that the effect is same. If you see the executor's total account is 291, that is still matching. The better presentation, follow that one. Put it to capital directly. Why? Because this is not the loss that we are facing because of revaluation. This is the loss we are facing because of omission. Okay, so it's better if it comes in capital account. Done now? So we are done with this. So we are done with admission, retirement, death. Till death we are done. We'll discuss dissolution and only dissolution is left. And that we have. We are talking about partnership. We'll do. Don't worry. No doubts about it. Okay. Now let's discuss about dissolution of the firm. We'll discuss about dissolution. We'll solve one or two problems and we'll end it. What is dissolution of the firm? The end of the partnership firm. In what all circumstances partners can only dissolve? In what all circumstances court can dissolve? Now this question is subject to law. I thought that and all I will not discuss. Okay, we'll directly come to accounts. Whenever the firm is getting dissolved. Do you understand one thing? Dissolution of firm is different than dissolution of partnership. See, in admission, retirement, death, what is happening? Partnership. In dissolution of their assets, what will you do? Whatever assets or liabilities we'll have, we'll pay it off that day and we'll end the firm. Whatever assets we have, we'll sell it off. Realize money, give it to liability, capital and everything, we'll pay it off and close the firm. So this is our intention. we have in dissolution of the firm. So for that, what will we do from accounting angle? First, we'll prepare realization account. And what is our intention? Our intention, our intention is to whatever ledger account that is open in the books of accounts. First thing, you have to close all. I'm talking from accountant point of view. Whichever ledger account is open, I have to close because I'm closing the firm. So whatever asset accounts you have, you transfer it to realization. Whatever assets, don't care, transfer it to realization. Whatever liabilities you have, transfer it to realization. Now, do you have other assets and liabilities? No. Okay. But not all assets you have to transfer. What all you have to leave? You have to leave partner's capital. You have to leave cash. Why? Because realization we are doing, we are closing the firm. We need those two accounts to do settlement. If I close those two accounts also, who will do settlement? Correct. So I transfer all assets and liabilities except capital, cash. Then what about reserves? Even reserves are ledger accounts. What to do? That I will not put into realization account. I will directly transfer them to partner's capital and I close it. With the reserves closed, capital I'm keeping it open, cash open, other assets are transferred it to realization. Now only accounts that are open is realization, cash, partner's capital. Reserves was there, but I transferred it to. Then one more thing, correct. One more thing which you have not put is partner's loan account. You'll directly transfer it to. You either pay it off if you have money or transfer it to capital and then pay off. Anything is. If you have sufficient money, pay it off outside. Okay, partner's loan. So what are the accounts open as of now? Realization, partner's capital, cash, and partner's loan. Partner's loan, you pay it off. Okay, you've paid it off. Now the accounts open are three: realization, partner's capital, cash. Now my intention is to close these three accounts. Okay, what will I do? Realization, I will. First thing I'll do is I've transferred everything. Now the second thing I'll do is I'll start selling all the assets. Now I would have realized money. What will be the entry? I've realized money, so cash account is open, cash or bank account. So cash or bank account debit 2. You don't have other assets only, no? You have transferred everything into realization. So we'll use realization account. So bank account to realization. Say suppose next year paying some liability. Realization account debit to bank because you don't have other liabilities account only open. Everything is now there in realization. So you'll use realization. If you sell assets, bank to realization. If to pay liability, realization to bank. Done. Then for realization, that is for selling of these assets, you'll incur some expenses. That also you have to pay. Entry? Because you don't have other accounts open. So realization account to cash. Then what do we have? Then sometimes what will happen? These partners, they'll only take over the assets because they'll not wait for realization. They'll take over. What to do? Since he has taken over, firm, whatever firm has to pay to him, that will reduce. So partner's capital account debit to because everything is there in realization to realization. Okay. What if partner takes over liability? That means my liability towards partner will increase. So I'll credit partner's capital, debit realization account. Then one more crazy case will come, which I have to tell. Then you have liabilities. Now in the question, they would have not told about liabilities, whether we have paid off or not. But what will be our assumption in this chapter?
Paid off.
Even if nothing is told, we will pay off the liabilities. So entry will be realization account debit to bank because we don't have other accounts. If money is coming, bank to realization. If money is going, realization to bank. Okay. One more thing. I'll ask you one more. Creditors to cover assets. Creditors to cover one furniture.
Creditors to furniture.
No, all that account is not open. Only account is realization. Then what will you do?
Creditors to realization.
No, creditors is gone. No. Now you have put everything to realization.
Realization to realization.
Exactly. The entry is realization to realization. Does that have any effect in the realization account? So what you have to do, whenever in the question they have told creditors taken over something, you will not do anything about it. Because the entry is what? Realization to realization, which however does not have any effect. Okay, now say suppose in question they have told creditors payable is 50,000 rupees. That is the balance I have. He took over assets worth 30,000 rupees and 20,000 rupees you have paid in cash. This is the adjustment they have told. What will you put in realization account? Hey, why creditors? It is gone. No, you have already put it to realization. Forget it. Now what has happened? Out of 50, 30 assets taken over, 20 cash paid. Now what? How much? That's all. You will show only realization to bank 20,000. That is whatever you have paid in cash. What about the asset taken over? You will not do anything about it.
We should not add anyways.
Nothing. Forget. If credit only, this applies only for creditor as a liability. If liability people take over assets, forget that it did not happen because it leads to realization to realization. Think about it. If you have to route it properly, this transaction, liability taken over, assets taken over by liability holders. Now, what would have happened? I should have sold this asset. I would have gotten money. The entry is bank to realization. Then that money, it is as good as me selling that asset and paying to creditor. No. So realize money, bank to realization. Then you pay it off to creditor, which is realization to bank, nullified. Since it is getting nullified, no need to pass those entries. If very important, if a liability guy takes over asset, no entry with respect to that transaction. Whatever you ultimately paid in cash, only that comes to realization account. Clear? That is one important. Then we are prepared with the realization, we get profit. That profit is shared among the partners in PSR. That is the
Realization account bank and the liability payment. So 20,000.
20,000 ಅಷ್ಟೇ ಕ್ಯಾಶ್ ಅಲ್ಲಿ ಎಷ್ಟು ಪೇ ಮಾಡಿದ್ರೆ ಅಷ್ಟು ಬರಬೇಕು ಎಷ್ಟು ಕ್ಯಾಶ್ ಅಲ್ಲಿ ಪೇ ಮಾಡಿದ್ರಿ 20 30 you paid in assets that you don't consider only
In assets, you're not sure.
don't do anything about it. Are we doing balance sheet or no again to consider non-cash? No.
They'll ask that the due paid to the partners is paid when the assets are realized. They give the date.
And that is the latest piecemeal distribution. We'll do piecemeal later. We have not gone there. Wait in the start. Then we'll get realization, profit or loss. We'll share it in PSR. Then what will we do? Reserves, if we have, we will share it in partners capital account. Then that is again that's this thing. What will you do if realization expense are paid by partners? Realization account debit to partners capital account because firm owes more to capital. No? I mean partners. No? So realization expense, realization account debit to partners capital instead of crediting cash or crediting capital. Done now? Then you prepare partners capital. Now realization account is closed. Then you have partners capital. Here opening balance, reserve, whatever realization profit, all this will come. Then whatever balance is there, we will pay it off. If they have debit balance, what we have to do? See, partnership firm has unlimited liability. Correct? No. If the partner's capital has a debit balance, then partner should bring the money. Assuming he's all solvent and everything. Okay. Again, when he becomes insolvent, that's a different rule. We're assuming he's a solvent guy. If he has a debit balance, if we are getting that guy should bring the cash. If he has a credit balance, we firm will pay it off to him. By doing this entry, partner's capital account is also closed. Then what will happen? We still have cash or bank. How to close it? See, it happens in such a way that when you pay off partner's capital, the cash account will also automatically gets closed. Now your books is entirely closed. No account is open. So this is about your realization. Okay. Later we have piecemeal distribution, which will come back to that later. Now we'll do realization, but it's already 10:50, so we'll take a break. Post coming back from break, we'll solve questions on realization. We'll finish piecemeal distribution also. Sorry? What? Piecemeal distribution. What should I say whether it's important or not?
As it has to take more than twice or thrice.
It is not asked more number of times. That is there, but I cannot assure you whether they'll not ask it next time. But yeah, it is asked for less number of times. That I can tell. See, you know what? It is very simple only. Okay. Hey, ನಾನು ಇನ್ನು ಹೇಳಿಲ್ವಲ್ಲ ನಾನು ಒಂದ್ಸರಿ ಹೇಳ್ತಿದ್ದೇನೆ Actually, it is very simple. In exam, they have asked it for, the questions is very small, very simple questions they asked. Okay, the questions which you have in study material is still big. Okay, since it is considered to be a rare topic, they're asking it very simply in exam. Now, if it comes to, it comes very simply. Easy marks to earn. Why do you want to leave it? So we'll cover it fast. Now 10-15 minutes discussion. If you still feel it easy, then go ahead. Or else you have to say. Should we continue? We are not here. So let's continue this. We have taken January 25 RTP question. Let's start. Neptune, Jupiter, Venus, Pluto had been carrying on in business and partnership, sharing profits and loss in the ratio 3:2:1:1. That is their PSR. They decided to dissolve the partnership on the basis of the following balance sheet as on 30th April 2024. Okay, they've given everything. So general reserve, what will you do?
Shall be partners.
Will not go to realization, will go to partners. Capital reserve,
Same.
same. All the reserves, same. Creditors, okay. Mortgage loan, liability. Then we have debit balances for these two people. Okay. See, just because they have debit balances, does that mean that they are insolvent? Debit balances, they are supposed to give partner, part firm. Firm is not supposed to give. Just because they have debit balance doesn't mean they are insolvent. If they are insolvent, they will give it the question. Now, assets were realized. Okay, all this will come in realization account. Credit side. This dissolution expense, debit side. Further creditors of 12,000 had to be met. Further creditors of 12,000 had to be met. That means? So that means it was an unrecorded liability. Further, we have creditors of. So what will you do? See, you don't care. You are paying 12,000 rupees. Entry, realization account debit to bank 12,000. The loss towards 12,000 will automatically be booked. Again, no need to increase creditor, then transfer it to realization, then no. Same thing. Whatever you have paid will come in realization. Then general reserve, unlike capital reserve, was built up by appropriation of profits. Why they have given this information? It's a biscuit. No matter how it is created, now the reserves will be transferred in partners capital in PSR. You are required to drop realization capital bank account, assuming that Venus became insolvent and nothing was realized from his private asset. Apply the principles later on in Gardner versus Murray. So Gardner versus Murray is there. So what is Gardner versus Murray? Guys, if among the partners that we have, if one of the partners is insolvent, then Gardner versus Murray will be triggered. There are two rules that you have to follow as per Gardner versus Murray. Rule number one, whatever realization loss will be there, of whom? Solvent partners. Now, say suppose A, B, and C partners are there. C became insolvent. A, B are solvent. You understand what is solvent is? Insolvent means the guy does not have sufficient money to pay his creditors. Okay. Now, first rule is the realization loss that we'll calculate. That should be bought in cash by the solvent partners. Right? What do we generally do? We just allocate it. Here, along with allocation, these two solvent partners should bring it in cash, really. First rule. Second rule? What is second rule?
The loss of the insolvent partner.
Exactly. If there is any deficiency of the insolvent partner, if firm has to give partner, it is positive. If partner has to give to the firm, it is deficiency. That means debit balance in capital account. If he has debit balance in capital, does he have money to bring? No. So that loss will be borne by solvent partners in their capital ratio. These are the two things which will come into picture. Okay. Now, one more question. A, B, C, 1 C became insolvent. A, B are solvent partners only, but B has debit balance, but not insolvent. In that case, how will we do this?
First we will get the details of First we should take from solvent partners, then
So the two rules of Garner versus Porter was one: bring realization loss in cash. The guy has not become insolvent, so he can bring realization loss in cash now. Yes. So two partners A and B, they will bring the realization loss in cash. But the third thing, where the deficiency of the insolvent partner should be borne by two solvent partners who are A and B. But B does not have credit balance, he has debit balance, but he is not insolvent. What we have to do? This guy should not bear the deficiency. Entire deficiency of C should now be borne by A. Is B insolvent? No, he's just a solvent partner with debit balance in capital. This guy will not bear the loss of the deficient partner. Will he bring realization loss in cash? B? Yes, he will. Clear? There is one thing to know. These two things, if you know, we can solve it. So here what has happened? Venus has become insolvent. Nothing came from his private asset. That's it. No money is coming from him. That's all. Apply the principles. So first we'll prepare realization fund. Come on, guys. Let's prepare realization. You prepare realization and tell me what is the problem. Whoever will give the realization profit or loss correctly, definitely for them it will be an advantage in the exam. ಕೊಡ್ತಾ ಇದ್ದಾರೆ ಅನ್ಸುತ್ತೆ ಅಂತ. I have strepsils if you want. I'll give you one. So first, what will you do? Transfer all the assets and liabilities to realization. So all the assets will come inside debit side. All the liabilities will come in credit. So put it on. So assets we have premises 1,20,000, furniture 40, stock 1 lakh, debtors 40,000. Liabilities we have creditors 20,000. Then we have loan 80,000. Everything transferred to realization account.
20,000 direct liability.
Total how much will we pay to creditor? 20 plus
80.
12 loan. 20 plus loan is different. Creditor 20 plus 12. We pay off 32 to creditor. 80 loan mortgage.
So mortgage loan is divided over mortgage something like that. That would have come.
ಅಷ್ಟಲ್ಲೇ ಬರಬೇಕು. ಅದೆಲ್ಲ ಆಗುತ್ತೆ ಬಟ್ ಅದೆಲ್ಲ ನಿಮಗೆ ಯಾಕೆ ಟೆನ್ಷನ್ ಡೂ ಇಟ್ ಆಗುತ್ತೆ. Or I can say like this, mortgage ಅಂತ ಹೇಳಿದ್ರೆ ಯಾವ್ದು ಅಂತ ಹೇಳಿಲ್ಲ ನಾನು ಏನು ಮಾಡಿ so I've done it normally. So then we have received money towards realization of the asset.
1,26,000.
Correct. So loss is 1,26,000. That you divide it in there PSR. Neptune gets, what is the PSR? 3:2:4. 1:1.
Gets 54.
54. Jupiter gets 36. Venus gets 18. Pluto gets
18.
18. Done. All of you done huh? With realization. 1,26,000. 1 lakh?
26.
It is 26 only, no doubt. So, guys, I'll just brief it up again. We have realized assets. How much money we got? 90 plus 16 plus 60 plus 24. 1,90,000. Bank to realization account. Then we have to pay off. Do you have any realization expense?
Yes.
That is realization to bank 4. Then we have paid off creditors how much? 20,000 plus 12. That is 32,000. Then we have paid off mortgage loan 80,000. Even if they have not told, we will pay it off. You know that with respect to liability. So that is all. Then that will come in capital. In realization, the loss is 1,26,000. Then now let's start with partners capital. So I think this also we have Garner this one. So I'll also do. So next we have partners capital. Particulars. Partners. Jupiter, Venus, Mars. Particulars. Particulars NJV. Okay. Opening balance. How much is opening balance of N and J? N and J have credit capital balance. 1 lakh and 60,000. VP debit balance.
10,000, 12,000.
10,000. 10,000. Then we have our reserves. So let's distribute. Separate again by
24, 16,
general reserve. Divide it in 3:2:1.
24, 16, 8, 8.
24,
16,
16,
8,
8, 8. Then
6.
we have capital reserves.
6, 4, 2.
6, 4, 2, 2. So reserves done. Then realization, loss we have. Correct? It will come this side. 2. How much it is?
54, 36, 18,
36?
18, 18, 18.
18, 18. The realization loss is done. Now we'll start with our Gardner versus Murray provision. So first thing is what? Realization loss should be bought in cash by the solvent partners. Who are the solvent partners? NJPR. They will bring the realization loss in cash. So entry is by bank account debit to partners capital. They are bringing cash. So by bank or cash, which one they are used?
Bank.
By bank. N will bring 54,000. J will bring his share of 36. V will not bring. P will bring 18. So first condition done. Second, the deficiency of the insolvent partner should be borne by solvent partners in which ratio? Capital. So come on. How much is our V's deficiency? 8 plus 2, 10 now. Here we have 28.
18,000.
So it is 18,000. Now this 18,000 should be borne by solvent partners who are having credit capital balances. All three have credit balances. No. If you see, V, this guy P does not have credit balance. Only N and J. That means this loss should be borne by only N and J in their capital ratio. What is their capital ratio? 5:3. Now, two system of capital will be happening. One is fixed capital, one more is fluctuating capital. If it is fluctuating capital, cool. If it is fixed capital, cool. We'll directly take the fixed capital ratio because capital will be intact. Simple. If it is fluctuating capital, what you have to do? Except for revaluation, what all will give generally? All that we have to give it to the partners and then consider that capital. What do we give? Generally, we'll have their capital balances. Okay, not this stuff. Not because of realization or something. Normally, what and all will you give? Normally, we'll give capital balance will be there. We'll give share of profit. We'll give interest on capital. Normally, in P&L appropriation, what and all will you give? Salary if you have, will give. Interest on capital if you have, will give. Commission you'll give. Interest on drawings and all if is there, you'll consider that. If you transfer to reserve, that is different. To capital people, what will you give? Share of profit, commission, salary, interest on capital. All that you consider. Normally, whatever you give it off, except revaluation profit or loss. That effect should not, because that is happening now. Okay, except for revaluation, what all interest, salary, capital, share of profit, interest on drawings, whatever you have to charge, all that you give effect and consider that capital ratio. Okay, now here if you see this question, all that is not there. Okay, we can directly take the fixed capital. Okay, do we have any interest on drawings to do, capital, salary, anything to do? Nothing. So come on. So their ratio will be 5:3, which is however given in the question only. So what will be the journal entry for this adjustment? Now, since the insolvent partner's deficiency is being taken by the other partners, now the balance of insolvent partner will go away. Now this insolvent partner has debit balance and credit balance. Debit that should go away. So I have to credit. So two insolvent partner and debit solvent partners always. Okay, this is the krama. Solvent to insolvent. Solvent partners are N cap, J cap to V cap. Correct? How much is V cap's deficiency? 18. This will be shared among N and J.
11,250.
6,000.
18,000.
Something is there. Ratio is what?
So they've added GR.
Correct. So whenever I say this capital ratio is there, no? This is okay. This. So whenever you are considering capital, okay, it should be capital plus their accumulated profits also, no, which is as good as capital that is lying now in reserves. So what we do is we take capital plus reserves balance, because ultimately if you do normal accounting other than partnership, what you would have done to profits, you would have directly transferred it to capital. But in partnership, instead of transferring, they have put it in reserves. Reserves is nothing but what? Reserves is nothing but the accumulated profits, which should have gone to capital. So we have considered reserves also. So let's do this. Who are the two solvent partners, N and J? They
1,60,000.
And?
1,60,000.
1,60,000. Okay, 1,60,000.
1,30,000.
24,000.
Then how much is the general reserves?
24,000, 16,000.
That we have to apportion it in the same ratio. It is 16. And again, that also apportion. How much? 6,000 and
4,000.
because it's nothing but their profit which they would have added to capital.
So, but they have mentioned general reserve is unlike capital reserve, which is appropriated with profits.
In the
Question.
question. But still capital reserve is still capital profits only. See, general reserve is trading profits, normal profit. Capital reserve is profits in the nature of capital. For example, you remember your forfeited shares or your securities premium. These are what? Profits that are capital in nature. Now tell me, this profits belongs to whom? If you are dissolving today only, partners only. Don't you think it is as good as their capital only? I'm talking only about reserves. Okay. So capital plus reserves, both will be added. Both are their profits only. The nature is different. General reserve considers of trading and normal profits, whereas capital are capital profits, but both belongs to partners only. I don't think that should affect. Now what is this?
30,000 and 80,000.
This is 80,000. So the new ratio will be.
30:8.
So this is the capital ratio you have to use. See, one crazy thing you came to in this question. That is Reserves you should consider while considering capital ratio. Okay.
Why
Both.
should we consider capital ratio?
Huh?
Why should we consider capital ratio?
Hey, I've already told you. See, profit sharing ratio is for what? Sharing profit that you are earning from the business. If the business is running and if it is earning profit, you use PSR to share the profit. But now are we running the business? No, we are bringing everything to an end. Now, whatever you are sharing is not profit. Whatever you are sharing is the assets, net worth of the firm. Correct? Huh? It is net worth of the firm. Now, net worth of the firm should go to each partner in PSR. How much capital they have invested and how much profit they have. Okay, because profit is ultimately added to capital only. No? Capital plus reserves is equal to assets minus liabilities. Now, the balance sheet items should be shared in PSR. That doesn't make sense. Balance sheet items should be shared in the capital they have because we are ending the business. So that's why Garner versus Murray told we have to use capital ratio. This is nothing about future business. Or this is not about operating profit. It is about sharing what we have. That's why capital ratio comes into picture. Clear? Yes. Now we'll share it in 13:8. So come on.
11,142.
0.8.
We'll make it 143 then.
6857.
6857. So 2 VCAP account 11,143 6857. These two here by NCAP by JCAP 11,143
6857.
okay. So we're done with Garner versus Murray. One important thing to note is this: while considering capital ratio, please consider capital plus accumulated profits. Okay. Yeah, in realization, yes. And if you have Garner versus Murray, then do it like this. Okay. Even in the RTP only. Now what will we do? Now after doing all this, whatever we have to pay off, we'll pay it off to the partners. See, N, first N. How much we have to pay?
1,18,857.
2 lakh? 1 lakh?
18,857.
1,18,857. J?
73,140.
73,143. Then
00.
what about V? V gone. We have cleared it off. P?
We has to bring it.
P has to bring in how much? Can P bring? Yeah.
2,000.
He is still solvent. I thought they have not told you this solvent. He can bring. Only thing is he had debit balance. That's all.
2,000.
He'll bring 2,000. Done. Huh? We're done with capital. Now we are left with bank account. So bank account now should automatically tally debit credit. Huh? Come on, guys. First,
Particulars.
oh, check. Oh, ಬೇರೆ opening balance
8,000.
8,000. Then
Realization.
from realization we got some 1 lakh.
1,90,000.
Hey, 1,90,000. From realization of assets. Then how much did we pay to creditors? First we have paid realization expense, which is
4,000.
4,000. Then we paid off creditors 82,000. Then we paid off mortgage 80,000. Then
Yeah, combined to say like,
1 lakh.
you guys have combined. Then one entry will be sufficient. I generally do it separately only in realization account. Both same effect, no problem. But try to show it differently. Realization expense, show it differently.
that we should.
Creditors and liability can combine. That is still no problem. Next. Then these people, they bought it realization loss in cash, no? Who all? And then all of them. N, J, P. N bought how much? 50?
54.
J bought
36.
and P bought
18.
18 plus 2 in the end also he bought. So it is 18 plus. So it is
1,10,000.
20.
Realization expenses.
We put down. Then we paid off to N.
1,18,857.
Then
73,143.
73.
143.
That's all, no? See if it's time.
2,08,000.
3,08,000.
Yeah, great. Done now. So next, so we're done with dissolution, and we have that one small thing, which is your piece speed distribution. Okay. So in piecemeal distribution, so what is piecemeal distribution first of all? Now what happens? Now whenever resolution of the firm is happening, breakup, piecemeal. Whenever we are doing resolution of the firm, what we are doing? We are realizing assets and paying off to the people. Correct? Just for the information I'm telling, whenever you are realizing assets and paying it off, will you pay it simply like that? One order of priority should be there. What is this order of priority? First priority will be for realization expense. Why? Papa, that guy came only when partnership firm decided for realization. Why should that guy face all that? So first we'll pay off realization expense. Second priority is for outsiders liability. Third priority is for partners loan, and next priority is for partners capital. This is the order of priority. Okay. Now, whenever you are realizing assets and giving money in this order, will you get all the money with respect to all the assets together in reality? No. Some assets will get sold first, then some assets will get sold next. So you'll not get the entire realization in one shot. You'll get it in different piece. That's why it's called piecemeal distribution. When you are getting the money at different pieces, will you wait till the end? Hey, let everything come, then only into distribution. You cannot wait. Okay. So when you have to do distribution in such cases, whenever you are getting money in different pieces, that is guided by our piecemeal distribution. Okay. Whenever you are getting money in pieces, how to distribute? There are two methods. One is maximum loss method, and one more is highest relative capital method. Okay. Two methods we use to do piecemeal distribution, and first one is maximum loss. Okay. Now we'll take a small simple example ourselves. Okay. ಮತ್ತೆ problems ಎಲ್ಲ ಮಾಡು. Okay. Say suppose 1, 2, 3, 4, 5. Okay. First you have realized 2 lakhs. Next you have realized 3 lakhs. Next you have realized 50,000. Next you have realized entire money did not come, realized it in this order. Okay. Now you have creditors of 1 lakh. You have partners loan of 1 lakh. Then your capital balance is 590, 590, 690, 490. Okay, it's okay. Capital is 1 lakh each. A, B, C. 1 lakh. 1 lakh. Okay, this is how we have to pay. Okay. Now, what you do is you put a statement, creditors, outsiders liability, because first you pay them. Next you pay partners loan, then you pay capital A, B, C. Now what is the balance? This guy you have to pay 1 lakh. Partners loan 1 lakh. Capitals 1 lakh. 1 lakh. 1 lakh. Now first realization is 2 lakh rupees. Okay. You'll give it to whom? First you give it to creditors and partners loan. So first realization 2 lakh. First then second realization. Okay, from here your actual maximum loss method will start. Okay, see this method both is only for distributing money among partners, not for outsiders. Outsiders were always clear. First you pay off outsiders, first you pay off partners loan. That is always clear. No need to do anything. Only when it comes to partners, the problem arises. Yarik first put this. To whom should you give first? Because all of them are partners. That's why we do these two calculations. Now from here we have to give it to partners. No? So what you have to do?
The 3 lakh, 1 lakh.
So we have got realization, we have got more realization. This is not the case. Okay, so what I'll do is I'll make it
Increase the capital.
yeah, I'll make it 3 lakh, 3 lakh. Okay,
So you make different proportions.
it's okay, that is not a problem. That matters in the second method. Okay, now you got 3 lakh rupees. Okay, what you will do is how much is the total? Now what you have to assume is this is the last realization that I am receiving. Okay, I have to assume how much? 3 lakhs. Okay, if 3 lakhs is the last realization that you are receiving, then what will be the maximum loss that the firm faces? 9 lakhs is what the firm has to pay. 3 lakhs you are assuming it to be the last realization. The maximum loss is 6 lakhs. So what we are doing is we distribute this 6 lakhs in PSR. Normally, the maximum loss will be distributed in PSR. Now divide 6 lakhs in the PSR is say 1:1:1. Now, okay. So how much is remaining? This remaining amount is there. No, this is the distribution.
So 6 lakh you have divided. So
Yeah. 6 lakh into 1:1:1. I've divided the maximum loss.
Divided in capital ratio.
No, divided in PSR ratio. In PSR only. So 1:1:1. So it is 2, 2, 2. So remaining is, if you even take out loss, if you apportion loss also, still we have capital balance of 1, 1, 1. This is how you pay them off. So because how much did you get? 3 lakhs. The 3 lakhs will be paid as 1 lakh, 1 lakh, 1 lakh each to each partners. The remaining money will be the distribution.
So 2 lakh is remaining.
No doubt. 2 lakh is the loss apportion. See, capital balances we add is 333. If 3 lakh is assumed to be the final realization, what is the loss? 6 lakh. That I have apportioned.
So you're not assuming that we get the money in the future also.
No,
You're not assuming.
we don't know. Okay, as a first realization, what I'm assuming is this is the final realization. So still we have to pay 1 lakh, 1 lakh, 1 lakh. That we have paid it as if. Okay, 1, 1, 1. Next.
Currently the loss is 2 lakhs.
Assuming that we'll not get any other realization. So we have paid how much? 1, 1, 1. Now, what is the updated balance? See, out of 3 lakh, you have ultimately paid.
1 lakh.
So updated balance is 2 lakh. Again, do the same thing. Next realization is 50. Assume 50 to be the last realization. 6 lakh capital you have. 50,000 is the
5 lakh.
final realization. Loss is 5 lakh 50,000. This you distribute in PSR 1:1:1. Divide.
1 lakh 3,000.
It's still
1840. 1833.
okay. 1.8, 1.83. So remaining
1 lakh
17.6. 67K. Okay. 16.67K. 16. This is how you distribute the 50K. Done now? Now, what is the updated balance? Updated balance is out of 2 lakh rupees, you paid how much? 16.67. So remaining
18.
okay. This is the remaining balance. Now next realization, 40,000. So what is the total capital? 5 lakh 50,000. Correct? If you add that much, you get 1 plus 1.83, 1.83, 1.83. Remaining capital is. Now next realization is, assume that is the last realization, so maximum losses. Now divide this. So how much will you pay? 13k, 13k, 13.3k. Okay, 13.3, 13.3, 13.3k. That is how you will pay off the 40,000. Understanding? Simple. Fifth realization also same thing you will do.
First we should take that remaining amount, then we should like 1.83 we should add it, then after
What is the updated? How much? See, at this level, you had 333, first capital balance. Then you apportion the loss. The remaining will be 1 lakh, 1 lakh, 1 lakh. You pay them in 1 lakh, 1 lakh, 1 lakh. So out of 3 lakh, how much did you pay? 1 lakh. Remaining balance is 222. Now the next updated capital is 222, which is 6. The next realization is 50,000. So out of 6 lakh capital that I have, I got only 50. That means the maximum loss is 5 lakh 50 I'll apportion. That is 183, 183, 183. Okay, that means you would have paid how much? 16.67, 16.67, 16.67. That is what you have paid. Because how much did you get in the next realization? 50k. If you add this, you will get 50k. That is how you apportion it to them. I thought now the updated balance, last updated balance was 2 lakh. Out of 2 lakh, you paid off 16.67. The updated balance is 1.83, 1. Now for the next realization, what is the total capital? 1.83 plus 1.83 plus 1.8. Again, take the next realization, subtract, loss apportion, whatever remaining, that is what you have paid. This is the chakra. Simple. Now sometimes what will happen? I will tell you. Some next complication. So you are doing this. I thought, say suppose here you do 3, you will apportion the loss 2, 2, 2. You here got 1, 1, 1. Correct? Sometimes in question what will happen? 1, 1, and this figure will come as negative. 2 lakh. Sometimes in the question, this will become negative. So what to do? Here you have to apply. What you are assuming is, when negative comes, the assumption we are doing is that they became insolvent. And we'll do Gardner versus Murray. What will we do in Gardner versus Murray? The share of deficient partner is shared among solvent partners in capital ratio. So this 2 lakhs will be shared among A and B in capital. In their capital ratio, which is 1:1. So 1 lakh, 1 lakh. So nothing is paid out of that realization. And here it's a different example. You're understanding now? That deficiency, you first set it off, minus it off from the solvent partners capital. Remaining you will pay off to solvent partners. Then same mathematics.
Capital is calculated in that method, distributing the reserves.
Yeah, capital ratio. Here and all that much complication will not come. This capital is only you can take.
Yeah,
Initial capital.
if deficiency comes against one partner, we should do what should like deficiency of A and B written off against C.
Okay, that situation is what? No, we are A, B, C. I thought you apportion the maximum loss. Then one guy is positive figure is there. B, C, negative figures is there. What will you do as per Gardner versus Murray? Both B and C deficiency should be borne by A. Subtract it from A, subtract B, C deficiency also from A. Remaining you pay off to A. Here we have one problem like this in our
What if
material.
its balance is less than those deficiency?
Then he'll bring him. No?
Again,
Bring it because he's a solvent partner and partnership form has unlimited life. His share of deficiency should. The question comes, sir, what to do if he's also insolvent? Then nothing. Everything will go to deficiency account. No one brings the money. We have that problem also, no? One problem we have where A, B, C, all of them are insolvent. I thought the situation will come. What will you do? No one will bring money. So guys, what to do? How will the accounts differ? If you have deficient, if all the partners are insolvent, what you have to do is put everything in realization account normally. One thing that you have to not put is outsiders liability because you don't have money for the outsider. So keep him aside. Rest all you do. I thought keep one guy aside to whom money is not sufficient. That guy you keep him outside the realization. Rest all accounts you do normally. And all the assets bring into realization, all the liabilities bring to realization, except creditor, the outsider liability. You do all the realization account, whatever profit or loss you get, show it in PSR account. Okay, PSR you did. Then what will happen? If you go to then your creditors, the outsider liability ledger is still open. Do you have sufficient cash to give? No, because okay, even if firm doesn't have sufficient cash, do we have solvent partners who can bring the money? No. So whatever money is there in the firm, pay it off to creditors. Still you'll have balance. Where will you put this balance? You have to close the account. Efficiency. You'll put it to deficiency account. Then you prepare normally partners capital account. You'll have some balance, some payable towards partners. Do you have cash to pay? You don't have cash to pay for creditors. So where will you put deficiency? Now deficiency account will tally because no one is able to bring money. If at least the partner is solvent, then if partnership firm does not have money, partner will still bring because unlimited liability. Understand? So that is one. So here you understood what was your doubt?
Both,
Understood, no, that thing. Yeah, if that guy has does not have sufficient balance, he'll bring it. Okay, because he's a solvent partner. If he's insolvent, nothing we can do. That's all. The piecemeal will stop there. Then until next realization comes. All that they will not ask. This much if you know it is sufficient. Okay. So then this is about your maximum loss method. Do you want me to solve a problem on this or can we go to the other methods? What do you think?
Sir,
Chance already time ಆಗ್ಬಿಟ್ಟಿದೆ. We have to start with company accounts. Next one. So next is highest relative capital method. Okay. ಇದೆ ಸರಿ ಇಲ್ವಾ? So ಇಲ್ಲೇನು example ತಗೊಳ್ಳೋಣ. This method is generally used whenever capital amount is not proportionate to their PSR. Okay. Now say suppose if there are three partners A, B, C and their profit sharing ratio is 1. But the capital invested by them is 3 lakh, 2 lakh, 1 lakh. Aita? Now we have to apportionate. However, if you have creditors or partners loan, first you will pay them off. Okay. So I will not consider that. The matter comes only when you have to pay it to these people. So how much was our first realization? Oh, the 9 lakh to me, na? That's a better one. So we'll make it 6, 4 and 2. Okay. So first realization is how much? I have 2 lakh. Before starting that, I have to see who has paid the highest capital in proportion to their PSR. I thought what we are trying to do in this calculation is say we three are partners. Okay, my share is 1 by 3, 1 by 3, 1 by 3. All three of us have same profit sharing ratio, but I have invested 6 lakh. You have invested 4. She has invested 2 for the same profit sharing, for the same share in the firm, in the profit. Is it correct? I thought this guy has paid a lot. A, me. So tell me, while repaying the capital, we should give preference to whom? And me, A, no, because he has paid for the same share, he has paid more money. So I have to give preference to A. That is exactly what we are doing in this calculation. So what we'll do is, we'll take their capital. Below the capital, we'll take their profit sharing ratio, which is 1:1:1. Divide it. 6 lakh by 1, 6 lakh. 4 lakh by 1, 2 lakh by 1, same thing here. Now what we have to understand is, for same share, C has paid 2 lakh, B has paid 4 lakh, A has paid 6 lakh. So what I'll do is, I'll take C's valuation as fair valuation. That means that guy got the same share at 2 lakh rupees. So I'll take that as base. Because that is the lowest, no. I have no other option. So I'll take the lowest value as the base. If I take this guy's valuation as base, then A was supposed to pay how much? For same share, A was supposed to pay only 2 lakhs. For the same share, B was supposed to pay only 2 lakhs. But they have paid 4 lakhs, 2 lakhs excess. Now I'll find out what is the excess. He could have got the same share at 2 lakhs, but he has paid 6 lakhs. That means excess is 4 lakhs. In this case, excess is here, no excess. Okay. Clear? Now what I'll do is, I'll do this calculation. Once I finish this calculation, now I'll see if it is in proportion. What is your proportion? 1:2. Is it matching?
No.
So X is still not matching. I will do this calculation until it matches with the PSR. So do the same thing. 4 divided by 1, 2, 1. Lowest valuation? 2 lakhs. 2 lakhs. This is nil. This guy is paid 2 lakhs. Excess. This guy? Nil. So done. Now is it matching? No, there is only one. It is matching. It came up to 1. Now in the realization, what I'll do is, whatever realization will come. The first realization was how much? 2 lakhs. That 2 lakhs first I will pay it off to. This is excess 2. Excess over excess. Okay. Now the first realization was how much? 2 lakhs. First I'll pay it off to A. Next realization is how much? 3 lakh. Now this 3 lakh I have to pay it off to whom? ABC here? No. Here if you see, we have excess of 4 and 2 at the second stage. But out of this 4 I already paid off 2 lakh. Remaining is
2 lakh.
now with the remaining whatever I have. What was the realization? 3 lakhs. The 3 lakhs I will divide it to A and B only until their excess gets over. How much is their excess? 2 plus 2? 4. But I got realization of 3. So what will I do? Out of 3, 1.5 give it to this guy, 1.5 give it to this guy.
That distribution is PSR.
In PSR only. What is that PSR? 1:1. So remaining 50k. Here also remaining
50.
Still we have excess of 50-50. What is the next realization? 50,000. Now 50,000 again. Will I pay it ABC? No, still we have excess. I'll pay 25. Still we have excess of 25. What is the next realization? Okay, 40. It is 20. Still we have. Next we have how much? 1 lakh. Out of 1 lakh, first I will pay there 10,000. So 5. 1:1. 10k I paid off. Now 90. This 90 I will divide it among these people. They had 6, 4, 12. Out of 6 I have paid off this guy entire 4 excess. To this guy I have paid entire. Remaining is 2 lakhs, 2 lakhs, 2 lakhs. It is matching with your PSR. 1:1. Now you pay off this 90,000 in 1:1 ratio, which is 30k. The remaining is 1.7, 1.7, 1.7. If you get further realization, you will do it. Continue. Huh? So we are just paying off the excess amount. Clear? So how did we do it? Take the capital, PSR, divide by it. You'll come to know the per unit valuation. Then you take the minimum valuation to be the fair valuation. That means this guy has paid for 1 share 2 lakh. So this guy also should have paid 2. So excess is 4.2. If you see, the 4.2 also is still not in the proportion of PSR. You have to see, when you get the first level of excess, when do you know that you have to go for the second level of excess? What you have to see the excess. 4 lakh, 2 lakh. Is it in the PSR? No, it is still. PSR is 1:1. But excess is 4:2. Not matching. Continue your process until excess becomes equal to PSR or it came down to one guy. Like this.
The amount is finished and then
That's all. If now amount finished, remaining capital 1.7, 1.7, we couldn't pay it. We cannot pay it. Gone. Firm has no money. Simple, no? Highest relative capital method. Okay. Why? ಆಗ ನಾವೇನಪ್ಪ ಮಾಡ್ತೇವೆ ಅದಕ್ಕೆ ಏನ್ ಮಾಡ್ಬೇಕು ಇವತ್ತು ಹೋಗಿದ ತಕ್ಷಣ ಹೋಗಿ ಮಾಡಿ ತಕ್ಷಣ ಕೇಳ್ಬೇಕು ಏನಾದ್ರು ಇದ್ರೆ ಅವಾಗ ಸರಿ ಹೋಗುತ್ತೆ 2-3 ದಿನ ಎಲ್ಲ ಗ್ಯಾಪ್ ಬಿಟ್ಟರೆ ಹೋಗೋದು. So that is about your highest relative capital done with partnership account. Now we'll enter company accounts in the last chapter. Okay, now what is company? Till now we learned about partnership, now company. Directly we'll come to matter. First, it is issue and forfeiture of shares is the first part we have to focus. Before that, some basic things you should need. I tell you. What is authorized capital?
The capital the company can raise.
The capital the company can raise. It is not what they have raised. It is what they can raise. Next, issued capital. Subscribed capital. Then called up capital. Yeah, called. Aita. Then called up annaga, you have to understand. Out of 10 rupees, 4 rupees I have called, I have received money. Further 2 rupees I have called, but I have not received money. So out of 10 rupees, how much is called up? 6. Even though if I have received, it is still called up because I have called up and received. Out of 10, 6 rupees is called. Out of that, 4 rupees is paid away. Okay. Ultimately, how much I have paid. Clear? This thing you should know. Then, tell me the journal entries. We can start. Whenever we are issuing the shares, we receive application money first. We receive application money, 2 rupees. And we are issuing only one share, so we'll consider that. Okay. So share application 2 rupees, 2 rupees. Then we allotted the shares. Then share application to share capital. Then allotted money called 2 rupees. To share allotment account. First we have to call it. So receivable you show. Share allotment account debit to share capital. Then when money comes, bank account to share allotment account. Then you'll first call. Same thing. For first call, bank first call to equity share capital. When you receive money, bank to first call account. So that's how you do. Now say suppose at the allotment stage we are receiving securities premium of 1 rupee. Total allotment money is 2 rupees. So what is the entry cost? 2 rupees to securities premium 1 to share capital 1. You know what is securities premium and all, right? Done. Then that is about it. Then shares cannot be issued at discount except for sweat equity shares of forfeiture. See, whenever we are issuing in forfeiture, it is not issue, it is sale of shares. Correct? We have already issued, but that guy did not pay, we forfeited. Then that share only we are giving to another guy. It is sale of shares. The reissue of forfeited shares. It is not issue of shares. That's why it can be done at discount. Because just now I told shares cannot be issued at discount. How can we reissue after forfeiture? Because it is not reissue, it is sale of forfeited shares. Anyways, not important exam point. Now, there is a normal issue entry. Then what we should know? Sweat equity share. Others, any shares which are issued to employees and directors. Director also employees only. So anything issued to employees and directors are called sweat equity shares. They will be offered at a price lesser than that's why it is called sweat equity. Okay. For their sweat, we are giving shares. Seriously, it is not a joke. Seriously, for the sweat that they are putting in, we are giving them ownership in the entity. Huh? Tell that it's okay.
Sir, but they work under AC.
Next level. This was brought in by Mr. Narayan Murthy. He was the one to bring this concept. Sweat equity shares. Narayan Murthy. Anyways, next what? We issued the shares, not possible at discount. Then next we have calls in arrears and calls in arrears. What is calls in arrears? You make the call, but those people will not give you the money. So we transfer this account to calls in arrears. So entry, when you make the call, say first call account debit to equity share capital. Later they did not give money. What will you do? Calls in arrears account debit to equity share first call account. You transfer it to calls in arrears. Correct? And calls in arrears and they are not paying it today. But they might pay it at a later date. Then what will you pass the entry here? You got the money at a later date. So bank account debit to calls in arrears account. Now since he is giving late, company will charge interest rate of how much? 10 not 12. Confusion example baro sadhite. So how I remember is, see, this rules is brought by government, correct? No? The government is always favorable to public. So in which case will public get interest? Calls in advance, calls in arrears. So that means they'll give more interest to public. So 12% is for calls in advance and 10% is for calls in arrears. Okay, Remember this. Okay. Now they'll collect interest at 10% from that shareholder. Calls in advance ulta. They are paying it early, much before making the call only. Now, since they are giving early, we'll offer them. We'll give them interest. That is called interest on calls in advance at 12%. Entry, bank account debit. We received the money in advance. Then calls in advance. We are giving interest. So, we are giving interest. It's an expense to us, no? So interest on calls in advance debit. Then bank account debit, interest on calls in advance debit to whatever calls you had made. Credit to call to calls in advance. Then you have paid the money, no? So to bank account. The combined amount, combined separate amount. So whenever there is calls in advance, what will happen? Say suppose I have called only 2 rupees. So entry for that will be first call to share capital 2 rupees, 2 rupees. But that guy gave off 10 rupees only. Now only. So bank 10 to first call to advance 8. Okay. This is how you will show it. Later when you pay interest is an expense. So interest account debit, say that interest is 1 rupee. To A. Money will go out now. To bank 1. Clear? Simple. So where will calls in advance come in your balance sheet? Calls in advance is a liability. So where will it come? Calls in arrears? See, I'll tell you. Calls in arrears will be subtracted from the paid up share capital. Okay. Calls in arrears will be subtracted from paid up share capital. Calls in advance will come in liability. Okay. Calls in advance, liability. Calls in arrears will be subtracted from paid up capital because we'll be showing the whole capital there. So we'll subtract it from a paid up capital is the reduced amount. From whatever called up capital will be there. From there we'll reduce calls in arrears. Then the net amount will go to paid up capital. Clear? Then where will forfeited shares account go? So that also will show in share capital. In share capital, we will add forfeited shares and we'll show in paid up capital. So whatever paid up capital we have, to that we add forfeited shares and show it in paid up capital. Correct? Calls in advance, liability. Calls in arrears, subtraction from called up capital. Then forfeited shares, addition to paid up capital. Clear? Any doubts till here? Done. So calls in advance, calls in arrears, done. Then forfeiture. Now these people, they did not give us money. Calls in arrears. Now what will we decide? We decide to cancel their share. That process is called forfeiture of shares. Now what is the entry for forfeitures?
Share capital account.
Now till now, since you are cancelling everything, whatever you have called up with respect to the share, entirely you debit it. I thought capital has a credit balance. Now you don't want that. So debit everything. Equity share capital, debit to the extent of whatever you have called up. Okay. Now let's take an example. Application we have paid 2 rupees. Allotment we have paid 2 rupees. First call we have paid we have called 2 rupees. Okay. That's why you get called 6. Okay, 10 rupees face value. So first and final call we have called 6, but we have not received, because of which we are forfeiting the shares. Now we are forfeiting. First debit whatever you have called up. How much you have called up out of 10 rupees? Entire 10 rupees you have called up. That's why I clarified it in the first one. 4 rupees is called up and received. 6 rupees is called up and not received. But what is called up? 10. So 10 rupees. 2. Then whatever money till date you have received, that will go to share forfeited as profit. So forfeited shares account. 4 rupees is received till now. This is not received. No? So 4. 2. Where is this 6 rupees balance appearing? In bank. It is there in calls in arrears. If you have not transferred to calls in arrears, then it is there in first call account. So first call account, or if it is transferred to call scenarios, whichever account, it is 6. Clear? This is the forfeiture entry. Now one more thing I will tell. Application 2, allotment 2, first call 6. Aita. This is not received. These two things is received. Let's make it 7. Okay. Because I'm issuing the shares at 11. 1 rupees is premium. And I've collected that premium in allotment stage only. Okay. So first call money. First call allotment. What will be the entry? Allotment money we are calling first. Entry? Allotment account. Debit 2 to equity share capital 1 to securities premium 1. Then we received it also. Entry? To allotment 2. Now you have called first call. Entry? Equity share capital, which is 7. Now he did not give the 7 rupees. Now we are forfeiting the shares. What is the entry? Now first I have to debit equity share capital by how much? By the total amount that I have called. How much I have called? 11 I have called, but 1 rupee is premium. That cannot come in capital account. So how much? 10. Debit 10. Okay, but now with respect to forfeiture, one matter is there. Here's securities premium. Securities premium is what? Money paid by the shareholders for the demand that I have. And the people are ready to pay more money for my shares. So that is company's profit. We have already received the profit also. That is profit you gave me because of my demand. So if I have already received securities premium, in forfeiture I will not consider. And I will not give them back. Although you gave it for my demand. All that I will not give you back. So if I have received securities premium already, will I consider in forfeiture? No, I'll ignore. SP, then I'll ignore. So no SP. 2. Forfeited shares, how much you received? Though you have received 2 plus 2, 4, but you consider only 3 because securities premium will ignore. So 2 forfeited shares. 2, how much is there? Where is 7? 7 is there in first call account. So first call account 7. So if you have received securities premium already, don't consider, forget securities premium is there. If you have already received. Same, let's alter the example. It is not collected here. 2 is it is collected here. As 1 rupees in 7. What will you do? First you have to call. First call money. First call to ESC. It's 7 no? ESC? 6. So SP? 1 no? You called but they did not give. Now you have to forfeit. First ESC, how much is called up? Entire 10. 11 but 10 because capital account 10. SP, have I received it or not? I have not yet received, so I can bring it. SP account debit 2. Forfeited shares I have received 2 plus 2 4. 2. Final call 7. If you have not received, I'll consider securities premium. If you have received, I'll forget that securities premium exists. This is based on this idea only. There are many crazy questions here. That's all. Nothing else is there in this chapter. Okay. So that is all. Then we have the case of. It's better to do oversubscription, some problem only. What is there to tell? Because you know what is oversubscription. What is oversubscription? I've issued only 1 lakh shares. Okay, I've issued only 1 lakh shares, but people have subscribed for 2 lakh shares, say so, or 3 lakh shares. For more shares than what I've offered, if people have applied applications, then it is oversubscription. Ulta? Now, whenever you're issuing the shares, okay, if you issue the shares, as per company law, minimum 90% should be subscribed, minimum subscription. Then only you can proceed with issue. If you get 80%, you cannot proceed. Whatever money you have received with respect to 80%, you have to return within 15 days. That's where underwriters come to the picture. Who are underwriters? And 90% is minimum. Alva. If your subscription becomes 80, you'll pay an insurance premium for them. So if the subscription becomes 80%, they'll come in between, they'll take the remaining 10%. And they'll make sure that issue is successful. They are like some insurance company. They are underwriters. Okay? That is again theoretical. And practical it is there. For you it is theory. Nothing on that. So we'll take one problem only about oversubscription. That is some crazy thing. Do you have any crazy problem? What is our question only?
22 also.
No, we'll take this only. No?
So 22nd.
In which one? That only will do. No need to do article.
That's easy.
Okay. All of you will do the that. Question of page number.
281.
Yaudri? 22nd. Hey, this question we have in one of the articles. Nice. Okay. We'll do this. Okay. Shall we start? Done. X Limited. X Limited invited applications for 75,000 equity shares of rupees 10 each at a premium of 5 per share. And the total amount was payable as follows: 9 rupees per share on application and allotment. They are given together. So whenever they are given together, these also considered together. Like in a bifurcation, they are not given. So how much? 9 rupees. This includes premium. How much is premium?
5.
5 is 5. So out of this 9, 5 rupees is premium, 4 rupees is capital. Balance on the first and final. How much is balance? 15 only 9 if they have received. Then 6 rupees is first and final. Then next. What has happened? Application for 3 lakh equity shares were received. Now this is the case of oversubscription. For 75 we have received 3 lakh. Applications for 2 lakh equity shares were rejected and money refunded. Guys, for 2 lakh we refunded. Apportionment ella madake hogilla. One more thing. In oversubscription, how will we allot shares? Two things are there in reality. One is pro rata allotment, one more is lottery. So what you do is 75,000, you'll put cheaty. Literally, they'll do lottery. Literally. But that is not literally cheaty, there some mechanism they have. So they'll put cheaty, they'll take 75,000 shares, then whoever name will come up, they'll give it to them. That is one way. This is how your IPO happens. If you're involved in IPO, there is no way. Hey, literally they don't do cheat. They have a software for all that, which does all that. Of course, literally cheat. Just for you to understand, I'm telling you. The probability is as good as cheats. Then, that is lottery. One more is this thing. For remaining people, what will we do? For 75,000 shares, we allotted them by a lottery. Remaining, we'll refund it. One more is pro rata. Pro rata, many people would have, now, each of them would not have applied for 1 share only. Some 2, 2, 3, 3 shares they would have applied, or 5, 10 shares. We'll allot them on a pro rata basis, on a ratio. How will you calculate this ratio?
3 lakh is
Total shares that I have to issue, the total shares that I can allot is, and how much applications I have. See, in this case I have 3 lakh, but 2 lakh upfront, 2 lakh people upfront I have refunded. So how much is there actually? 1 lakh is the actual applications I have now, because 2 lakh upfront I refunded to those shares. So this is the ratio in which I will allot. Andre, which is nothing but 3:4 allot. We'll give for every 4 shares applied, we'll give 3 shares. For every 3 shares, for every 4 shares they have applied, we'll give 3 shares. Understood? For every 1 share applied, we'll give 0.75. Okay, multiply into 4 into 4, 3. Now, what was it telling? So you understood the idea of pro rata allotment. Idea. Now say suppose, now how many, just to give the idea again, 4 plus 1, 5, here 6, 7. So 7 plus 5, you have 12 people. I have 12 chocolates with me. How much will I give? One for each. Now, all of you will put a demand. Sir, all of us want 2 chocolates. But I have only 12 chocolates. What will I still do? Huh? Okay. Half and put rest up over one. So still I can give only one. So what happened here? For every 2 5 stars, say suppose 5 stars that I have asked, I have given you 1 5 star. Now the ratio is 1:2. Now say suppose all of you will ask, sir, we want 3 5 stars, but I have only 12. So what will I do? I will give 1 only to all of you, but the ratio became 1:3. For every 3 5 stars applied, I am giving you 1 5 star. Like this one here, what is happening? For every 4 shares they have applied, I am giving them 3 shares. So that is determined by this ratio. How will you calculate this? Shares the shares that I can allot divided by total applications I have received. Clear? Now come back to the question. I have received application for 3 lakh. 2 lakh upfront I have refunded. So 1 lakh I have still. For 1 lakh, what am I doing? For 1 lakh, shares were allotted on pro rata basis to the remaining applicants. Okay? For 1 lakh, I did pro rata. That means for every 4 we are giving 3.75. The first and final call was made. Done. The amount was duly received except on 1500 shares applied by Mr. Raj. So what happened here? First and final call we made. Everyone paid. This guy, Raj, he did not pay. First and final call made. What we have to focus on in this question is, they've used the word shares applied. So if shares applied equal to shares allotted? No. The applied shares is 1500, but we would have allotted him how much? In the ratio of 0.75. So 1500 into 0.75. So we would have allotted him 125 shares. This we should not forget. This is the matter. So pass necessary journal entries for the above transactions in the books of X Limited. So that's all they have asked. So there are journal entries. So first journal entry will be what? Receiving the application money. So you have to combine because our separate account. So bank account debit to equity share application and allotment account. How much? 9 rupees into 3 lakh applications we have received. So 27 lakh. Then what will be? Then we have allotted all 3 lakh. No. Only 75,000 we have allotted, and remaining 25,000 what we have done? We would have adjusted it for English shares with chicken money 800 shares for other remaining applicant. Okay, for 2 lakh people we have refunded the money, but for that 25,000 what did we do? 2 lakh we refunded, clear. I thought, but we still have applications for 1 lakh, but we can allot only 75. What about 25? The thing is, whatever excess money we have with respect to the applicants, that excess money I'll use it for the next stage, that is first and final. I would have adjusted it. With respect to 1 lakh people, 2 lakh I have upfront refunded. Okay, so next stage will be, what will be next stage? We'll write it down. First, bank account to equity share application and allot. It was how much? 3 lakh, the 27 lakh. 27 lakh. Okay. Before going to this, let's write one small working note for the clarity. Okay. So how much is the here shares applied? Okay, I divide it into 2 lots. One is out of 3 lakh that we have got, 2 lakh and 1 lakh. Why did I divide it as 2 lakh and 1 lakh? Because for 2 lakh we have upfront refunded. Pro rata allotment has happened only for 1 lakh shares. Now shares applied is this much. So application money received first, we would have received 2 rupees, 9 rupees we would have received. Application and allotment. So 9 into 2, 18 lakh we have received towards application. In the second case, 9 lakh is right. With respect to 2 lakh shares, entire money is immediately refunded. Okay, will you write this? How much did we allot? To first guys, we did not allot anything. So nil. For the second guys, we allotted 75,000. No, shares. I'm just talking about shares. Now, how much money is required for application? We'll do one thing. First and final call, how much money is required? With respect to 2 lakh people, no money is required because we will refund them. For the next case, we need 75,000 with the shares allotted. So on that only we'll call for final. So 75,000 into 6, 4 lakh 50,000 is the money that I require for the final. So how much will I refund ultimately? So this guy ultimately entire 18 lakhs I will refund because I have not allotted anything. What about the second case? So out of 9 lakh rupees that I have received towards application, how much is required for application? 75,000 into 9 rupees is required for A. For application allotment only how much is required? So out of 9 lakh, 6 lakh 75 is required for application allotment only, no? Because how much will go to application allotment? 9 rupees for 75,000 shares. That much I have allotted. So still excess, how much do I have? This 2 lakh 25 excess I have. How much I require towards first and final call? 50. But I have excess of 2 lakh 25. So how much should I receive from them? Only 2 lakh 25,000 is the amount I have to receive. Any doubts here? The second one. So second one, we have got application for 1 lakh shares and we have done pro rata allotment. So 1 lakh shares, how much allotment did we do? 75,000. So we need application and allotment money only for 75. So how much required? 75k minus 9 rupees. 75k into 9 rupees. So towards application we require only 6 lakh 75. But how much we have received as application allotment? Out of 9 lakh, we require only 6 lakh 75 for application allotment. Excess money is 2 lakh 25,000. And next, for the next first and final call, how much is required? 6 rupees is the first and final call. And how much shares is allotted? 75,000 shares. 75,000 means 6 rupees weight. So how much? 4 lakh 50, no? How much have I allotted? 75,000 share. On allotted share only I will do first call. So 75,000 into 6 is 4 lakh 50 is the money required for first and final call. But I have excess of how much? 2 lakh 25,000 excess I have. So how much will I ask from these shareholders? Remaining 2 lakh 25 only. Any doubts? Exactly, yeah. Oh, okay. Okay. Good. We'll do one thing. So application money received anta idan hinge ಮಾಡ್ಕೊಂಬಿಡಿ. So shares have divided. Next stage is application money received. How much? 18 lakh and 9 lakh. Okay. Then one more column for your understanding I do. Application and allotment money required. So tell me, how much application allotment money I have to actually take? With respect to 2 lakh shares, nothing because they are refunded. With respect to 1 lakh shares, how much I want? Application and allotment. Though they have applied for 1 lakh, I will allot only 75. So I require 75,000 into 9 rupees. So required is 6 lakh. Is the required? Is the required? So excess is there. In the first case, entire 18 lakh is excess. In the second case, excess is clear. Now first and final call money required is to pure denuvilla because we are not allotted. To them we have allotted 675. On that we need final call money, which is how much? 75,000 into 6 rupees, which is what is the actual money received or paid? Paid na minus saldos. So first case okay na we paid off entire 18 lakhs because nothing we did. We received, we paid off. with respect to these shares, we have paid how much? Sorry, we have to receive 4,50,000. We already have an excess of 2,25,000. So how much will we actually receive? ಅಷ್ಟೇ. This was better, no? First time ಮಾಡಬೇಕು ಇವೆಲ್ಲನ ಜೋಶ್ ಹೋಗ್ಬಿಟ್ಟು. Okay. Huh? Yeah, but one column I did not show, that's all. Okay. Anyways, now clear. Now this is very important. Now let's start. So whenever we receive money, bank narration and all I'll ignore. Okay. Huh? Bank account debit to equity share application allotment 27 lakh, 27 lakh. Then now we have to, from here, application allotment, it should go to capital. That entry we have to do. So total equity share application and allotment account debit 27 lakh. But what did I do out of the 27? Certain I allotted. How much? To the extent of 75,000 I have allotted. So 2 equity share capital, 75,000 into 4. So it was 3 lakhs. Do we have premium in all?
Yes, sir.
Yes, sir.
In the first stage only, yeah?
Yes.
So how much it is? 5 into 75,000. So how much?
370.
Hey, 5 is
3 lakhs, sir. That is 3 lakhs.
This is 3 lakh only, yeah. Then to securities premium, that is 4 rupees.
Sir, it's 375,000.
Hey, Rappa, I know. Premium is 5, capital is correct. 8.
Sir, it's 3 lakhs only, sir.
Hey, that you should have told. 75 into 4, 3 lakhs. Then here, 5 rupees into 7. So it's
3 lakhs.
3 lakhs 70. So I allowed. Then what did I do? For that 2 lakh people, I refunded the money. So 2, how much I gave off?
18 lakh. 18 lakh.
Still remaining, I have money. That what did I do? I adjusted it towards first and final. So what will I do? I credit to share first and final call because I've adjusted towards. Which will be how much? Because this is the excess now. If you see our calculation, exactly this is the excess now. Okay, 2,25,000 done. Next, what we have done? Next, you have to call for first and final. So entry. How much? On allotted shares only I can call. So 75,000 into 6. How much?
4,50,000.
2 equity share 4 lakh. Then the entry is about receiving the money. Now the question is, what happened? There was one guy, everyone paid except this Raj guy. So that should go to calls in arrears. Correct? But how much he did not pay? Adhike we have to put a working note. So come here. Working note to how much is calls in arrears by Raj. So how much he applied? Shares applied.
1,500.
Applied is 1,500. Shares allotted 1,125. Correct? So that means how much money is received from him? With respect to application, we have received
13,000.
9 rupees, which is 13,500. How much is required for towards first and final call? Money required towards first and final call from Raj is 1125 into 6, which is 6750. Now what we'll do is, how much we have to calculate how much excess he has. So money received from it towards share application is 13,500. But how much is the money required? Okay, wait.
10,000.
Money required for application and allotment is how much? Only 1125 into 9, which is 10,125. ಇಷ್ಟೇ ಬೇಕಾಗಿಲ್ಲ. ಎಷ್ಟು excess ಇದೆ ಇವ್ರದ್ದು? 3375. This excess will be adjusted towards first and final call. Excess is 3. So how much is Raj supposed to actually pay?
337.
So this 3375 he has not paid. So how much will go to call scenarios? 337. Clear? That means remaining we would have received. So how much money we are technically supposed to receive? 2 lakh. Why 2 lakh 25? Why not 4 lakh 50? Because 2 lakh 25 already we have excess no here. Excessive. So the money we are supposed to receive only is 2 lakh 25. So what will happen? Bank. Did I receive 2 lakh 25?
No.
I received 2 lakh 25 minus. Then there are 2 lakh 21,000. So remaining 3375 is to share first and final thought. It should be 2 lakh 25. Done. Now after this, what we are supposed to do? We have to forfeit his shares. Okay. Now what is the entry for forfeiting issue? Only Raj, that guy's share will forfeit. Okay. Now, that means how much? 1125 shares. Okay. So equity share capital account to the extent called up. How much have we called up? See, entire amount we have already called up. That is 15 rupees. And 10 no, plus premium 15 rupees. Adರಲ್ಲಿ premium is already received. Yes, the allotment is already received, so I will not consider. So 10 rupees, 1125 shares debit. Securities premium will not come. 2 forfeited whatever, non-forfeited shares. So forfeited shares, the amount actually received by him. Hakovik now. Okay, na? So the direct amount one should match to the. Okay. Money actually received. Okay. So how much we have received? First application money was for 1,500 shares into 9. We have received 13,500. Okay, na? Now I'll bifurcate into 2 parts. One is allotted. One is unallotted. Okay. Same amount I'm bifurcating. Okay. How much is allotted? So 1125 into 9 is how much?
10,125.
And this is remaining is 2,500. 375 into that is. So the money paid I've divided into 2 parts, allotted, unallotted. And now tell me, this 9 rupees includes premium of 5 rupees. Includes premium of 5 rupees. Now in forfeited shares, should I take the effect of 5 rupees?
No.
No, because premium is already received. But should I do that for unallotted also?
No.
Unallotted is actual money, no? So here I'll consider 375 into 9, 3375 only. But here, in 9, this is allotted. Here I will not consider the premium component, which is 1125 into 4, which is
4,500.
so the money actually received, which we'll consider there is 4,500 plus 337. How much? 78. So this is the amount I'm considering. All of you understood this math? Okay. See, out of 13,500, only 1125 I have allotted. So all that security premium rule will apply for 1125. 375 was unallotted, no? Why will I not consider premium of that? That is not premium only, that is excess money. Right? So 7875 is the amount. Remaining 2, we have how much? 3375 in call scenarios. So calls in areas 3375. Done? Or what you can do is you can take this as balancing figure. See, simple methods will be there, but you should know properly. That is my intention. Okay. I could have done that easily, but I did not because I want you to understand. Okay. Then next thing,
Reissue.
we have reissued it at a discount of 4 rupees. How many shares? 1125. So bank account 1125 into how much money? At discount of 406. So, then what will you do for discount? For discount, we'll use up forfeited shares. So forfeited shares account to 1125 4,000. 2 equity share capital. So it is 1125 into 10. Okay. Then that's all. We still have one more entity. Whatever is remaining in forfeited shares, we have to transfer it to. So since we have reissued all the shares, no need to do anything. We have reissued all the shares. Any working note to be done? No. So how much forfeited shares we have? Balance is 7875. Out of that we used up 4,500. Remaining will transfer it to capital reserve. How much is the remaining? So forfeited shares account 33752. Capital reserve 337. Done, huh? All of you understood? Good question only it was.
Sir, can you show the tables? Working on.
I feel that working note 3 is very important. That is where you will do something. Huh? Alla, question is there okay, but very type in you should know the concept correctly.
Only after table.
Of what of? Technology.
Talking of the recording
ಯಾಕು ಯಾಕೆ ಒಂದು ಮಾಡ್ತೇವೆ
ಮುಂದೆ ಟೈಮ್ ಇಲ್ಲ ಅಂದ್ರೆ ಫೋಟೋ ತಗೊಂಡ್ಬಿಡ್ತೀನಿ.
ಏ ಆಯ್ತಾಯ್ತು ಆಚೆ ಆಚೆ So next what to do? Enough of issued forfeiture. Let's go to the next unit. Next unit is debentures. A issue of debentures is also same thing. Only one thing what you should need to know in debentures, I'll tell you. The point you should not ignore. Okay. In issue of debentures, the entry is very similar. Ditto. For preference shares also entry, ditto. For issue of preference shares. For issue of debentures also entry is similar. But what will happen? Sometimes in case of debenture, you can issue it at a discount. 3 possibilities. Par, and you can issue it at par or premium or discount, and you can redeem it at par or premium. That redeem at discount all. Redeem is possible at par or premium. Okay. Now let's take an example. Only idonda step. Say suppose you have debentures which has face value of 100. You are issuing them at a premium of 105. Okay. And you are redeeming them at a premium of 110. So tell me what will be the journey. If you can tell this, you know everything about debentures. Debenture, one debenture. We are talking about one debenture. Face value 100, which is getting issued at 105, and will be redeemed at a premium of. So how much money we are getting? 105 because I'm issuing it at premium. This is debit 105. But you are redeeming it at a premium of 10 rupees, which is your expense. So loss or discount on issue of debit. How much? You're giving premium of how much? 100 compare ಮಾಡಬೇಕು. By redeeming, I'm giving more with respect to face value. So premium is 10. 2 debenture, but something can go to debenture only to the extent of 100. Your face value, which is 100. Remaining is what? 2 securities premium of 5, but still it is not matching. This is there, no? We have liability with respect to this premium which we are supposed to. That is to premium on redemption payable, which is 10. Clear? Now, one more example. If fee is 100, I am issuing at a discount of 95 and I am redeeming at a premium of 110. Bank account, how much did I actually get? 95. I am already issuing it at a discount of 5. But plus also during redemption, I am giving a premium of 10. My total loss on issue of debenture is 5 plus 10, 15. So, loss on issue of debenture. So it is 5 plus 10, 15. Issued under whenever I am issuing the debentures to the public. ಇಲ್ಲ ಎರಡು ಲಾಸ್ ಡಿಸ್ಕೌಂಟ್ ಇದೆ ಅದನ್ನ ಸಪರೇಟ್ ಆಗಿ ತೋರಿಸೋದು both are expensive. 2 debentures face value. Face value. Debentures should always be getting for face value. 2 premium. We are redeeming it at premium, not securities premium will come only when you issued at premium. Correct? So premium on payable. Then what will happen to this loss? In any case, what will happen to this loss on issue? Will be transferred to, its expenses will be transferred to P&L. Entirely money, no. Then we will distribute it over the life of the or term of the debenture. In which ratio? SLN. Sorry, equal. Other than we'll distribute that in the ratio of outstanding amount every year. See, before coming to revision, you should have revised, no? Then it will help.
Science student ತರ ಅನ್ಸ್ತಾ ಇದೆ.
ಎಷ್ಟು ಸಲ ಹೇಳಿದೆ ರಿವೈಸ್
Chemistry equation feeling.
ಕಾಮರ್ಸ್ ಯಾವಾಗಲೂ ಈಸಿ ಇತ್ತಲ್ಲ, ಇದ್ಯಾವಾಗ ಹಿಂಗಾಗೋಯ್ತು? That's why we have it on recording also. Anyways, so this we will divide it in the ratio of outstanding amount over the term of debentures. Hangadre hinge ಎರಡು possibility. One possibility, we have issued debentures now and repaying in the end. ಎರಡನೇ possibility, we are issuing debentures now and repaying maybe before the final date. We might pay it in middle also or pay every year, something like that. Two possibility. One, you are paying it at the end of the. One more possibility, somewhere in the middle you are paying off the principal. Okay. In the first case, what will happen if you are paying in the end and say suppose the term of debentures is 5. Okay. That means how much will be outstanding every year? First year outstanding will be 100. Second year outstanding will be 3rd, 4th, 5th. 5 year also outstanding is 100 because you are paying it off at the end of 5th year. So ratio is 1:1:1:1:1. So 15 rupees, which is a discount, you divide it by into 1/5 because 5 years. Ratio is 1:1:1:1:1 because outstanding. Same amount is outstanding over 5 years. So 15 into 1/5, 3. Every year will transfer 3 rupees to P&L. Entry is P&L account debit to loss on issue 3 rupees. Either 5 years you'll do 3, 3, 3, 3. Debentures da. So for 5 years we'll do it, and your loss on issue, which is technically an asset. So this account, what is the nature of this account? It should be asset. Every year it will be in the asset side. Okay. Then second year, what will you do? You'll charge 3 rupees to P&L. So this asset will reduce. 3 rupees will go to P&L. Next again balance became 12. Next year again 3 rupees will go. It becomes 9, 6, 3, and 6, 3, 0. Like that, you are writing off the asset over 5 years. Say suppose you are not doing like this. You are repaying it and the 20 rupees you are repaying every year. So first year outstanding 100. Second year outstanding 80. Third year outstanding. Fourth year
40.
20. That's a 5 years. You will divide 15 rupees in this ratio. What is this ratio? 5,4,3,2,1. Okay. Now 15 rupees. First year, how much will go to P&L? 15 into total is 15. No discount. 15 into 5 by total is 15. How much will go? Second year, same. 4 rupees. Third year, 3, 2. So every time here it went straight line. Here it will become 5, 4, 3, 2, 1 every year. Entry will be P&L to loss on issue, but number will change. Here 5, 4, 3, 2.
For which one is straight, everything is.
I told you, no, if you are repaying it in the end, then same every year. You can just do by 5 or by term. If you are repaying it in between, then find out the ratio. Every year, how much is outstanding. Then distribute it in that ratio. Clear? That is one thing that you should know in issue of debentures. Rest all is fine. Same thing, same entries. Okay. So next unit is
Redemption of preferential.
we have bonus rights issue and redemption of preferences. Then we have redemption of debentures. Okay, now. So first we'll take which one we'll take. Okay, we'll take bonus and rights issue. What is bonus shares? Shares which are freely given to the existing shareholders of the company. Free equity. See, whatever profit is accumulated by the company will come and sit in reserves. Okay, that will either be given as dividend to shareholders, or one more thing, what we'll do, we'll utilize the same reserves and we'll allot them shares. That is called bonus issue. When I say issue of bonus share, what do I mean? Issue of full bonus shares. Full bonus shares. Now there are some conditions for you to do bonus. One of the important conditions is you cannot issue bonus share for a partly paid up share. Guys, bonus issue or bonus share is always given for whom? Existing shareholders. Before giving bonus shares to them, for existing shares it should be fully paid up. Without that, you cannot issue bonus shares. Clear? Now, for issuing bonus shares, which all reserves can you utilize? Because I told bonus share is also called as capitalizing of reserve. So what we are doing, whenever we give dividend, what will be the entry? If I give out dividend. Dividend is not an expense. Hey, if we give dividend. The dividend, where will dividend go? P&L. It cannot go to P&L because it's not a expense. It will go to reserve. So reserves will decrease because accumulated profit is there where? Reserve. So I debit reserves account and credit bank. Whenever you pay dividend, entries reserves account debit to bank account. But here what you are doing? Are you giving dividend in money? No, you are directly allotting share. So what will I do? Reserves account debit to bank to equity share capital because I'm allotting shares. So it will be reserves account debit to equity share capital. Can you use all the reserves however you want for issuing bonus? No. There is one priority that you have to follow. First, you can use this capital redemption reserves. Second, you can use this securities premium. Third, you can use this free reserves. For our understanding, free reserves means general reserve and P&L. But what is actually free reserves? Free reserves are those reserves which are available to be distributed as dividend. If there is any reserve, no matter what is the name, if you can distribute dividend from that reserve, then that reserve is called free reserve. And this reserve should not be formed part of notional profits. And then a reserve which is formed or created because of notional profits, that reserve is not a free reserve. Example, your revaluation reserve. You know what is revaluation reserve? Correct? So whenever you revalue the asset account will increase. Asset account debit to where will you credit? Whenever revaluation reserve account. Is it a actual profit? No, it's notional. The cost of that land was 1 lakh. Now you think it is 1 crore and you have increased the asset and you have booked the income in revaluation reserve. But is it actual profit? No. So can revaluation reserve be used for bonus? No, because it's not a free reserve. Anything made up of notional profits is not free reserve. And it should be freely available for distribution as dividend. These are free reserves. But for exam purposes, mostly it will be GR and PL. Okay. Now we'll use it in this format only: CRR, SP, GR, PL for bonus shares. Correct? Huh? Why are we using CRR first? Because CRR has only one purpose, that is bonus. That's why we are utilizing it first. SP also cannot be. Securities premium also cannot be used for whatever purposes. Only for 5 mentioned purpose as per section 52. Right? Not 5. It's actually 3. Because 2 are not applicable for company which follows accounting standards. You remember, SP can be used only for 5 purposes. Out of that, 2 is again not available for companies following accounting standards. So technically, now all the companies should follow. So technically, SP can be used only for 3. So since we have limited usage, if one of them is issue of bonus, out of that 5, one of them is issue of bonus. So since they have limited usage, we'll use it off first. First CRR, second SP, third general reserve, fourth PNL. 2, we'll debit all these reserves because reserves is getting decreased. 2, what is increasing? Your equity share capital. So what we'll do is, we have a practice of showing payable first. So CRR, SP, GR, PL debit 2, bonus to shareholders account. Then when we actually allot, bonus to shareholders account debit to equity share capital account. Clear? Whenever they are giving bonus, they'll always give you ratio. Like they say bonus is issued at 1:4. That means what? For every 4 shares that already exists, 1 share I'm giving as bonus. Clear? Second point. Now bonus can also be given in one more way. One more way is making partly paid up shares fully paid up. In the first case, till now, issue of bonus share means what? Giving 1 full share as a bonus. And there is one more way of bonus where they make partly paid up shares fully paid up. And let's say suppose face value is 10, I have paid only 5 rupees. Still 5 rupees the company can call. Okay. But what company can do? They'll not call only. They'll make that 5 rupees share as 10 rupees paid up without receiving money.
Reserves.
They'll take it from reserves only. Okay. That 5 rupees they made 10 rupees without receiving money. This is also one more way of giving bonus. Here am I giving full 1 share as bonus? No, I'm giving half, arda as bonus. So I told, if as per Companies Act, issue of bonus means issue of 1 full share, not part. So since this is part, CRR and SP cannot be used for this purpose. Because as per Act, issue of bonus share means issuing 1 full bonus shares. That case you can use CRR and SP. But when you are making partly paid up shares fully paid up, for that you cannot use GR and you cannot use CRR and SP. You can use your free reserves anyways. GR and PNL can be used for making partly paid up, fully paid. CRR and SP cannot be used. Only for issue of full shares they can be used. Clear? Done? That is about it. Then what else do you have in bonus?
Right.
We'll come to right. Anything else in bonus? That's all, man. That is all you have to do. Entry you understood, no? You'll utilize it in that order only. CRR, securities premium, GR, PL. GRPL, it's okay. Anything between GRPL, anything you can use as first. But CRR, SP first you have to use. 2, bonus to shareholders. Then bonus to shareholders to equity share capital. That is done with your this thing in the bonus shares. Then let's come to right shares. What is right shares? Here, right share, what is happening is, as per Companies Act, we have one important rule. That rule is, whenever we are issuing further, whenever we are issuing equity shares, first you have to offer to the existing shareholders. You can say, suppose you are a company, you need more capital. What you'll do? You'll issue further more shares. What is she doing? Sleeping, huh?
Reason
What was I telling?
said that the company issue the right of shares.
Then
You were
What-
explaining
then
that.
what is come right value?
You didn't explain.
Hey, see, I have told. Then what is come right value? Yeah, listen, no, tell. Hey, no, good, silent. ಹೇಳಿದ್ರೆ ತಗೊಳಕೊಂಡ್ಬಿಟ್ಟಿರ್ಬೋದು ಯಾರು ಏನೋ ಒಂದು ಮಾಡಕ್ ಬಿಡೋದೇ ಇಲ್ಲ ಅಂತ. ಏನ್ ಹೇಳಿದ್ರು? No, right shares. So what is right share? So as per Companies Act, the rule is whenever the company has to raise more capital, first the share should be offered to existing ones. So that's why right shares came into the picture. What is so great about right shares? They are issued to existing shareholders only at a price lesser than market value. That is the thing about right shares. Say suppose if market face value is 10, market value is 500. Hey, it is possible. If you see Wipro, Reliance and all, their face value is 10 rupees only. Their share is 1,500, 2,000. Okay. So the issue price is 500. Face value is 10. Then right shares will be offered at maybe 400 rupees or 300 rupees. Lesser than market price. Okay. Now tell me, whenever a company issues a right share, what will be accounting entry? Do we need to make any changes? Instead of 500, we are receiving 400 rupees. So entry will be bank account debit 400 to equity share capital 10 to securities premium 390. Ashte done. Just because I'm giving it at 100 rupees less, will my accounting change? No. So entry is as good as normal issue of shares. The only thing is price is lesser. Is it lesser than face value? No, lesser than market price. Okay. So from the accounting company point of view, no change. But from the person point of view, there is certain things to learn. Okay. Now me, I am already an existing shareholder of a company. Okay. Now rights issue also will be declared like bonus only, 1:4. For every existing 4 shares, they are ready to give 1 share. The market price is 20 rupees, but they are offering me it at 15 rupees. 1 share. I have 4 shares, they are offering me 1 share. Now me as an existing shareholder, what all possibilities I have? One thing, I can eat 5-star. And they eat 5-star, do nothing. They don't do anything, just be quiet. I have got record. One thing. So that is one point. Second, you can exercise the right share. That means you can pay that whatever money they have asked you for and take the right shares at a discounted price. Good thing. Third, this right you have now. You have one right. What is that right? Right to receive the share at a lower price. Andre, actually people are getting it for 20 rupees. You are getting it for 15. It's a right, no? So this right you can sell it to others, to a person, to a new shareholder who wants to buy a share. This is called as renunciation of right. Okay. Three things you can do. Okay. Now, one important thing is, sir, we will sell that right, which is okay. 1 and 2 is simple. Renunciation of right is what you have to understand. Sir, we will sell the right, but at what value will we sell? Adenne now continue. So, in the question, that is what they'll ask. As find out value of a right. This is the price at which you sell. Now, whatever the example I have taken, I have already have 4 shares. They have offered me 1 share as right share. Okay, 1:4. Market price is how much? 20. They have allowed me to take right share as at 15 rupees. This is all the given. From this, I have to find out the value of my right. Okay, that means how much that person should give me, the new person, to buy the right from me. So this is come right price minus X right price. See, the formula is crazy. Come right minus X right and all. But technically, come right price is market price before rights issue. X right is market price after rights issue. Okay, now what is the market price before rights issue? 20. They have only given. So it is 20 rupees already given in the question. No, nothing to worry. X right is market price after rights issue. But this they would have not given in the question. We have to find out. How will you find out? X right price. See, always, general math to understand how share price is calculated is that you take all the assets, you take all the liabilities, assets minus liabilities, and take the market value of the asset minus liabilities that you have. That is nothing but market value of the net worth of the company divided by number of shares is market value of 1 share. Can I say that? Market value of all the assets divided by number of shares is equal to market value of share. But to find out net worth, they have not given assets and liabilities only. Is there any way I can find out that? Assets minus liabilities is equal to capital. So have they given capital information? Yes. So with total capital is nothing but what? Net worth. No? Capital is equal to assets minus liability. So I'll take capital. Okay. Now, how much capital do we have? Capital plus reserve. Now, existing shares in the company, we don't have other information. So let's assume whatever is given is the given thing. So how much existing shares do I have? 4. It's 4 existing shares. What is the market price of these shares?
20.
This is the capital that I have. Plus, the moment I issue the right shares, how much money is coming? 15 rupees is coming. How much is the right share? 1. So 15 rupees is coming. This is the total net worth I have. First, this is capital. This is the money I further got. Divide by how much shares we have. Earlier we had 4. After rights issue plus 1, we have 4 plus 1, 5. So total 80 plus 15 by 5.
19.
Is it? Now if you see, the market price was 20 before rights issue, which has become 90 after rights issue. So all of you have to understand, this is also economics. Whenever there is more supply in the market, what will happen to the price? Price decreases. Same thing happens. Because right shares are issued at a price lower than market price, the supply has become more. Also the price has become lower. That's why 20 has become 19. Normal economics. Right? So 20, so 19, so we got extra price. So it is 19 is equal to 1. 1 is the value of right. Okay. What? The new guy has to pay me 1 rupee. No, this 1 rupees is per share. So what you have to do? 1 into value of right into existing number of shares you have to take. Existing number of shares. That is 1 into 4. So how much that guy has to give? 4 rupees to buy the right. The value of a right is how much? Value of right is this is per share. That is 1. But we have existing shares of 4. So 1 into 4. 4 rupees that guy has to give to buy this right from me. Understood? Yeah?
4 rupees is the number of the right.
Right. No. You can see technically 1 rupee is value of a right only, but it is calculated per share. But he should pay how much? For every 4 share, I am getting 1 right. So I have to multiply it by 4 to get the money that he has to give me.
He's paying 19 rupees per
For him to give that right of buying 1 right share, he has to pay me 4 rupees. Value of right is calculated per share if you think about it. Okay. 20 is what? 20, 19, both are 1 share values. So 1 rupees is the value of right. That I have to multiply it by number of existing shares to get the total money that should be given by that person. Okay. Then, now if you want to understand, Vaida? Now just to see the economics, okay. This guy had 3 possibilities. 1, first I'll do nothing. So what will happen if he's doing nothing? What to do if he's doing nothing? The guy did not renounce also, did not buy also. What will happen to him? See nothing. He right to sumne waste away. So what is the loss that happens to this guy? His market price, earlier his market price was 20 into 4. His shares value was 80. Now it became 19 into 4, which is 76. So if you do 5-star, do nothing, loss. Second possibility, renounce. Renounce ಎಷ್ಟು ಬಂತು? From renouncing the right you got 1 rupee value of right into number of existing shares was 4. So we have got 4 rupees there renouncing. And what happened to my existing share? It was 80, which has become 76. I have suffered a loss of 4. So loss 4. So 0. So if you renounce, you're in a position of no profit, no loss. If you don't do anything, loss. Then one more possibility, you can exercise, you can buy it. Then what will happen? Renounce. Selling that right. This guy has the right of receiving the share, no? That he'll sell it off. Okay. This is renunciation. Then one more is what? Holding. In holding, what will happen? Now he had 20 shares. He has got one more one more share, which you'll get it for 15 rupees. 15 rupees. See, with respect to the existing shares, the loss he faced is 4 rupees only. So minus 4 is the loss because of this thing. One more thing, what you have to do, you can buy the right share at how much? 15 rupees, and you can sell it for that was market price before rights. No? Now the market price after rights is, and the profit that you can make is, but still in this case the case is no profit, no loss. So if you do 5-star, do nothing, nothing good is happening. Loss will happen. To at least be in the same position, you should either renounce or buy it and sell it off. Okay. ಅಲ್ಲಿ ನಾನು ಬರೀ ರೈಟ್ ಅನೌನ್ಸ್ ಮಾಡ್ತಿದ್ದೀನಿ, but economics is like that only. The calculation and all is like that. Anyways, you understood. So what else is the effect of rights issue? That's all. Too much discussed. So how to calculate value of a right? That is important. Come right minus X right. Come right will be given in the question as market price before right issue. X right, what you have to do a formula. Formula is number of existing shares into come right price plus number of shares issued for rights into right issue price divided by total number of shares after rights issue, which is 4 plus 1, 5. You'll get the X right price. So subtract come minus right, X, you'll get the value of the right, and you get how much money should be given by that guy who is buying the right from me. What you have to do, multiply it by number of, very important, pakka you will miss it. How much should that guy pay me? It is not value of a right. Value of a right into number of existing shares. That is 1 into 4 is equal to 4 rupees. Don't write I should pay 1 and come. That is value of right. Value, if they just calculate value of a right, 1 rupees. How much money is supposed to be paid by the right buyer to this guy? If they ask, it is 4 into 1. Very clear? So that is about your right share. Okay? Anything? I think. Okay, January 25, this thing, we have a combined question of redemption and bonus and right. So what we'll do, we'll finish redemption also, and we'll do that question so we can end redemption and bonus. So what is redemption of preference shares? So you would have issued preference shares. Now we are repaying them back. That is called redeemable. So redemption of preference shares. Correct. So again, whenever you are doing redemption, can you do redemption for partly paid up preference shares? No. The rule is you can do redemption only for fully paid. In the question, they would have told the shares are partly paid up, and then they would have told do redemption. What will you do? So remaining money, call that money, make it fully paid up, and then start with redemption of preference shares. Okay. Next, what will happen? Whenever you are paying off redemption, the redemption of preference shares, you are paying off the preference shareholder. That means the capital. You are paying off the capital. Correct? No. Now tell me, if you pay off the capital, imagine the balance sheet. If you pay off the capital is gone from the balance sheet. Okay. Now who are remaining? Only equity share capital and creditors. Now the problem that is happening is, see, who should take the liability of the business when compared between creditors and preference share capital? Who is more owner? Who should take more ownership? Equity I'm not considering. Among preference share and this thing, liability. Preference shareholders. Now imagine what is happening. Whenever redemption is happening, this guy, what is he doing? Taking his money and going away. Generally, whenever firms go for liquidation or dissolution, what is the order? First outsiders, then preferential, then equity shareholder. That is the order of liquidation. Now here what is happening? This guy is taking the money saliently and is going away. Will creditors be quiet? Hey, wait, then what will happen? Guys, not all assets will be. See, if that guy is there, if the balance is there here in the creditor side, asset side also something will be there. What if accumulated loss is there in the asset side? Where will accumulated losses come? Profits will come in credit side. Well, like that, losses will come in debit side. It will be shown in asset. Now, if book assets and all is taken over by preference shareholder, then what will be there for creditors in the asset side? Accumulated loss, cheating. So that's why they not allow redemption, preference shareholders to leave just like that. So what they do is, reserves belong to whom? Owners only, alva? Owners only. Free reserves. They can distribute it as dividend whenever they want. Now what will these people do? Capital also redeemed. Whatever is there in reserve, that also they take it as dividend and creditors combo. Correct? Yeah. That is the reason base. Okay, so that's the problem that is happening. Now, how to resolve this problem? Now, to resolve this problem, the capital which is going away because of redemption should be intact. So, what will we do? We do the redemption. Once we do the redemption and pay off, whatever money is there in the free reserves, from there I transfer the exact amount of capital that I have redeemed to CRR account, the capital redemption reserve which we saw in bonus. Now, what happened? That money, the usage of that money is restricted. Correct? In CRR, it is blocked. Why blocked? Because what is the one and only purpose of CRR? So ultimately, what will happen in bonus shares? CRR will go to capital only. What was the entry? CRR to capital. So your money is intact. Your capital is intact. So what will we do? Once redemption is done, we will transfer the nominal value of the preference shares redeemed to CRR so that the capital is intact. Whatever capital went is now there in CRR. Exactly. Now my capital is intact, no problem. They cannot take it as dividend because CRR has only one purpose, bonus. Clear? Any doubts here? Okay. Then one more thing. Sometimes what will happen, they will issue equity shares only for doing redemption. They issue, say suppose 5 lakh redemption of preference shares you have to do. They have issued 5 lakhs worth equity shares. So they issued 5 lakh worth equity shares, got money, redeemed the preference shares. Here, what will we do about CRR requirement? See, what was our objective? To keep the capital intact. See, when 5 lakh went as redemption, 5 lakh has come as capital also. No? Preference capital gone, equity capital came, capital is intact. So, is there any CRR requirement to be done here? No. So, whenever they raise equity share capital, then they do redemption. No. First thing what you have to do is see how much equity share capital is already issued. What will you consider? Now, suppose whenever you have issued equity share capital, 10 rupees was face value, you have issued it for 50. Okay, for 5 lakh. Will you consider face value of equity shares issued? Issued value of equity shares issued? Why not issued? We have to consider face value. Why not issued price? Because issued price considers securities premium. Securities premium will go to reserve. If it goes to reserve, is the capital intact? No. I want if 5 lakh I am redeeming. If 5 lakh worth nominal value I am redeeming, then 5 lakh worth nominal value of equity shares I should have issued. Issue price I will not consider. Because only nominal value will come to capital. The excess will go to SP. I don't want that to come to SP. Okay. So you have to consider face value in both the cases. Okay. Now in questions it can happen two possibilities. What is they'll ask like this only. What is the minimum number of equity shares to be issued after utilizing all the reserves that you have? Okay. Now say suppose you have, what did I tell? You can issue, you can do redemption of preference shares from whatever money you have. And if you have not issued equity shares, then what will you do? From free reserves, you transfer it to CRR. Now, in the question they are asking, after utilizing all the reserves, how much equity shares to be issued on the creditor? That means what will you do? To the extent whatever reserves you have, you will utilize it. Right? Then will you be having any money, any amount left in the reserve to do CRR requirement? No, first only you have done. So, for the remaining amount, you have to issue equity share capital. You understood this, sir? Huh? If you utilize all the reserves and if transfer to CRR first only, then say suppose you are doing redemption of 5 lakh. Okay. Preferences 5 lakh. You have 2 lakhs in free reserves. They are telling after utilizing free reserves, how much equity shares to be issued on that. 2 lakhs free reserves, you are transferring it to CRR. You utilized it. But you are doing redemption of 5 lakh. What to do about remaining 3 lakh? Now to transfer to CRR, do I have any free reserves? No, I utilized it. Now the only option left is issuing of equity shares. Now for 3 lakhs I have to issue equity shares. Face value is 10, issue price is 12. I'm asking you how much number of shares to be issued. So 3 lakh divided by 12 madbeka 10 madbeka.
10.
Why not? Because I want capital to be intact. If I do by 12, what will happen? Number of shares will be something less than 3 lakh. Let us say suppose it's 2.80. How much will go to capital? 2.80 into 10 rupees. That is only 2,80,000 will go to capital for 3 lakh redemption. Is it correct? For 3 lakh should go. So that's why what will I do? I'll divide it by face value. So how many shares? 30,000. In case of 30,000 shares, what will happen? Entire 3 lakh will go to capital and extra money 2 rupees will go to security stream. That is okay, excess. But how much went to capital? 3 lakh. So 3 lakh redeem, 3 lakh redeem. So whenever in the question they ask, after utilizing all the reserves, minimum shares to be issued is how much? The amount remaining divided by nominal value. Very important. Sometimes secondary case they'll ask, they're not worried about CRR requirement. They're worried about we have shortage of fund. Since we have shortage of fund, we are issuing equity shares. It is not for CRR. The first one was for CRR. Second, they are telling because of shortage of fund, we don't have money, we are issuing shares. How much money is required for redemption? Say suppose 3 lakh is the nominal value. Say suppose we are redeeming preference shares at a premium. And premium amount is 30,000. Okay. Now they are telling we are issuing equity shares for the funds. How many shares to be issued? Now what will you tell? 3 lakh 30,000. 3 lakh is face value, 30,000 is premium. They're asking you for fund requirement, I'm issuing equity shares. How much will you issue? How much? Now, whenever there is a fund, you consider fund only. How much fund is required for redemption now? 3 lakh plus fund. I'm asking about cash. I'm not caring about nominal value, CR or anything. How much fund is required for the thing? 3 lakh for this thing and 30,000 for premium. So total fund required is divided by. Again, by issuing equity shares, what is my objective? I should raise fund. I'm not caring about CRR. I don't care about CRR. For me, fund is required. Now, will I divide it by 12 or 10?
10.
You divide it by 12. Because if you divide it by 12, will you get 3,30,000? Yes. I'm not worrying about the face value here. If I do 10, what will happen? You'll get more money. Aisa, why would you want more money? Divide it by 12. You'll get the sufficient money. But face value will be a little lesser than 3 lakhs. But I don't care. Because if CRR my important thing here, no. The second case, my important thing is fund. So I'm directly taking the fund required divided by issue price. Now you would have solved other questions. In issue of shares only. You remember issue of shares for consideration other than cash. Say suppose you are buying 4 lakh rupees. 4 lakh rupees worth building. 10 rupees is face value, 12 rupees is issue price. How many shares will you issue? 4 lakh divided by 12. You are considering issue price, right? Because if you divide it by 12, that guy will ultimately get 4 lakh. How? Whatever number of shares. If he sells it in market, he'll get how much? 12 rupees only. So ultimately he'll realize 4 lakh. So generally everywhere, okay, we consider issue price only. Only for CRR requirement we consider nominal price. Everywhere else in the chapter we consider issue price. Only in CRR requirement we consider nominal. That too in redemption also, if the requirement is fund, we use issue price only. Only for CRR requirements, where they say you have utilized all the reserves, how much shares to issue? Antaga. If you utilize all the reserves, then CRR complaint should be done by issue of equity shares only. Because there is no reserves to transfer to CRR. You have utilized already. So there you use nominal value. Any doubts? So what will be the entry for redemption? I think you'll be knowing. Whenever we are doing redemption, our preference share capital is decreasing. So preference share capital account debit. Then if you are redeeming it at premium, what to do? Premium is an expense. Premium on redemption account debit to preference shareholders account. Then when we pay preference shareholders account debit to bank. Clear? Okay. Any doubts? Then once you do the redemption, immediately what you have to see, CRR requirement. Is the capital intact? If you have not issued equity shares, what will we do? From free reserves, we transfer the money to CRR. How much? Nominal value of preference shares redeemed. If they have issued equity shares, then what you have to do? See how much equity shares is issued. Face value. Take total amount of preference shares redeemed minus nominal value of equity shares already issued. Remaining you transfer to CRR. Correct? Because to the extent of equity share capital is intact. Done? All of you. Hello?
Yes.
Hello?
Yes, sir.
ಎಲ್ಲರೂ ಏನ್ ಮಾಡ್ತಾರೆ? ಇದೆಲ್ಲ ಎಲ್ಲೋ ಕೇಳ್ದಂಗೆ ಇದೆಲ್ಲ ಅನಿಸ್ತಾ ಇದೆ. So we'll come to this problem. January. Oh, sorry, we were supposed to take one more break in between. No? Some of you have forgotten. Now we'll not take up. ಆ ಥರದೊಂದು ಜೋಶ್ ಇರಬೇಕು. ನನಗೆ ಲಾಸ್ಟ್ ಡೇ ಅಂತ ತುಂಬಾ ಜೋಶ್ ಇದೆ. ಸಾಕಾಗ್ಬಿಟ್ಟಿದ್ಯಪ್ಪ ಹೇಳಿದ್ನೆ ಹೇಳಿ ಹೂ ನಮ್ಗಿಲ್ಲ, ನನಗೆ ಹೂ ಹೋಗ್ಬಿಟ್ಟಿದೆ ಸಾಕಾಯ್ತು. ಎಲ್ಲಿದೆ? January 25. ಇಲ್ಲಿದೆ. Bonus issue and see this is the exact not this problem. We did another. Bonus issue and redemption of preference shares. Both is there here. So we'll see. The following is the summarized balance sheet of Trinity Limited as that 31. See, mostly it will be difficult for us to cover redemption of debentures. Now what to do? Now should I solve this problem or should I go to redemption of debentures?
Redemption of debentures.
That only will go.
Yes.
Others, ಎಲ್ಲರೂ ಹೇಳ್ಬೇಕಪ್ಪ, ಇಬ್ರು ಕೂಡ
Redemption.
we'll do this. We'll go to redemption of debentures. So this is ಮಾಡೋದು ಬೇಡ. I think Jay Sriram. No, the problem is simple only. ಏನು? ಅದು ಎಕ್ಸಾಮ್ ಅಲ್ಲಿ ಅಂದ್ರೆ ಎಕ್ಸಾಮ್ ಅಲ್ಲೂ ಅಷ್ಟೇ ಓದುವಾಗಲ್ಲ, ಅದು ಎಕ್ಸಾಮ್ ಬರೆಯುವಾಗ ಆಯ್ತಾ. ಎಕ್ಸಾಮ್ ಬರೆಯುವಾಗ ಇಟ್ ಇಸ್ ವೆರಿ ಡಿಫಿಕಲ್ಟ್ ಟು ಗೆಟ್ ಮಾರ್ಕ್ಸ್ ಇನ್ ಒನ್ ಪರ್ಟಿಕ್ಯುಲರ್ ಥಿಂಗ್. ಒಂದನ್ನೇ ಪರ್ಫೆಕ್ಟ್ ಆಗಿ ಮಾಡ್ತೀನಿ ಅಂದ್ರೆ ಆಗಲ್ಲ, ಅದು ಸ್ವಲ್ಪ ಕಷ್ಟ ಇದೆ. ಬಟ್ ಎಲ್ಲದ್ರಲ್ಲೂ ಸ್ವಲ್ಪ ಸ್ವಲ್ಪ ಮಾಡ್ಬೋದ ನಾವು? ನನಗಂತೂ ಅದೇ ವರ್ಕ್ ಆಗುತ್ತೆ. ಅದು ಒಂದು ಸ್ವೀಟ್ ಸ್ಪಾಟ್ ಇದೆ ಆಯ್ತಾ, ನಿಮ್ಗೆ ಹೇಳ್ತೀನಿ. ನನ್ ಸ್ವಲ್ಪ ಈ ಮ್ಯಾಟ್ರ್ ಜಾಸ್ತಿ ಎಕ್ಸ್ಪೀರಿಯನ್ಸ್. ಸ್ವೀಟ್ ಸ್ಪಾಟ್ ಏನಂದ್ರೆ ಇದು 0, ಇದು 100. ಓಕೆನಾ? ಸಿ ನಿಮ್ಮ ಮಾರ್ಕ್ಸ್ ಈ ಬಂದು 60ಗೋ 70ಗೋ ನಿಂತ್ಕೊಳ್ಳುತ್ತೆ ಅಂದ್ರೆ ಆಯ್ತಾ, ಓಕೆ. ಸಿ ಏನಾಗುತ್ತೆ, ಸಪೋಸ್ ಎವ್ಯಾಲ್ಯೂಯೇಟರ್ ಇಸ್ ಕ್ಯಾಲ್ಕುಲೇಟಿಂಗ್ ಅಂದ್ರೆ ಇಸ್ ಕರೆಕ್ಟಿಂಗ್ ದ ಪೇಪರ್ಸ್ until you reach 70 marks alva, that guy will be correcting aramse only. Andre he'll be very liberal for steps and all. He'll be giving marks for formats and all. He'll not remove because okay, what he'll be thinking, he has done the concepts correctly, one line he has not put, it's okay, he'll give marks. And you is correcting is a little liberal and your marks will come to somewhere 70. He's okay. The moment it becomes 80, he'll be like 80 marks then again then ICA will bash him. 80 marks and it is a good thing. Then ICA will be skeptical about it. So suddenly he'll come back. 80 antu baragilla. Format hakilla. So ನೀವು ತುಂಬಾ ಚೆನ್ನಾಗಿ ಮಾಡ್ಬಿಟ್ರೆ ನೀವು ಇಲ್ಲಿಗೆ ಹೋಗೋ ಸಾಧ್ಯತೆ ಇದೆ. ಇಲ್ಲಿ ಇನ್ವಿಜಿಲೇಟರ್ is skeptical. Correct? If you know something about everything, you land somewhere here only. ಇದು ಅರ್ಥ ಆಗ್ತಿದ್ಯಾ ಬೆನಿಫಿಟ್? 70 ಒಳಗಡೆ ಬಂದ್ರೆ ಲಿಬರಲ್ ಕರೆಕ್ಷನ್ ಆಗ್ಬಿಡುತ್ತೆ ಆಯ್ತಾ. ಎಲ್ಲ ಚೆನ್ನಾಗಿ ಮಾಡಕ್ ಹೋದ್ರೆ 80ಗೆಲ್ಲ ಹೋಗ್ಬಿಟ್ಟು ಮತ್ತೆ ಅವನು ಚೆಕಿಂಗ್ ಎಲ್ಲ ಮಾಡ್ಕೊಂಡು ಮತ್ತೆ 70 ಇಳಿಸ್ಬಿಡ್ತಾನೆ. ಯಾಕೆ ಕಷ್ಟಪಟ್ಟು ನಾವು ಅದ್ ಮಾಡೋದು? ನೋ ಎವ್ರಿಥಿಂಗ್ ಆಯ್ತಾ, ನೋ ಸಮಥಿಂಗ್ ಅಬೌಟ್ ಎವ್ರಿಥಿಂಗ್. ಸೊ ಆನ್ಸರ್ ಎವ್ರಿಥಿಂಗ್. ಸೊ ಪಕ್ಕ ವಿಲ್ ನಾಟ್ ಗೋ ಅಬೌವ್ 70-80. ಟ್ರಸ್ಟ್ ಮೀ. ಏನೋ ಒಂದೀಗ ಒಂದು ಕ್ವಶನ್ ಇದ್ರ ಬಗ್ಗೆ ನೀವೆಲ್ಲ ಬರ್ತಿರಲ್ಲ, ಈ 90% ಕರೆಕ್ಟ್ ಬರ್ತಿರಲ್ಲ, ಸೊ ಫುಲ್ ಮಾರ್ಕ್ಸ್ ಬಂದಿರಲ್ಲ, ಅದೆಲ್ಲ ಹೋಗಿ ಲ್ಯಾಂಡ್ ಸಮ್ವೇರ್ ಅಟ್ 70. That is how I have passed it. This is what I have learned over from my foundation days till final. That is how I do. No matter what, ನಾನು ಲೈನ್ ಆಗ್ತೀನೋ ಬಿಡ್ತೀನೋ, ನಾನು ಏನ್ ಮಾಡ್ತೀನೋ ಇಲ್ವೋ, ನನ್ನ ಹ್ಯಾಂಡ್ ರೈಟಿಂಗ್ ಚೆನ್ನಾಗಿದೆಯೋ ಇಲ್ವೋ, ಐ ವಿಲ್ ರೈಟ್ 100 marks. ಅಂದ್ರೆ ತೀರಾ ಸ್ವಲ್ಪ ಅಲ್ಲ. ಈಗ ಒಂದು 5 marks ಕ್ವೆಶ್ಚನ್ ಇದೆ, ಇಟ್ಸ್ ನಾಟ್ ಲೈಕ್ ಐ ನೋ ಓನ್ಲಿ 1 mark ವರ್ತ್. ಐ ವಿಲ್ ಬಿ ಪಕ್ಕಾ ನೋಯಿಂಗ್ ಆರಾಮ್ಸೆ ಮೋಸ್ಟ್ ಆಫ್ ದ ಟೈಮ್ಸ್ ಐ ವಿಲ್ ಬಿ ನೋಯಿಂಗ್ 5 marks only. ಆಯ್ತಾ? Sometimes 3-4. But the thing is, my perfection is not to the extent of 5 marks. I know the content, but the perfection level of the content is not 5. So I'll end up getting 3.54. Okay. Why focus on perfection? Focus on knowing everything then. ಎಲ್ಲದರಲ್ಲೂ 3.5 ಬಂದರೆ it is 70% of the marks. Total is 70. Exemption. In my final, I've got 5 or 6 exemptions. I've got. You know what is exemption? More than 60 in each paper. ನೋಡಿ ಕರೆಕ್ಟ್ ಆಗಿ 60 ಮೇಲೆ ಬಂದಿದೆಲ್ಲ. ಅದು ಎಕ್ಸಾಮ್ಷನ್ ಅಂದ್ರೆ 90 80 ಅಲ್ಲ, 65 64 67 62 ಈ ತರ ಎಲ್ಲ 60s ಅಂದ್ರೆ ನಮ್ದು ಪಾಯಿಂಟ್ ವರ್ಕ್ ಆಗ್ತದೆ. ಸೊ ಒನ್ ಥಿಂಗ್ ದಟ್ ಹಸ್ ವರ್ಕ್ಡ್ ಇಸ್ write 100% of the paper and read something about it. So something you'll get in everywhere. This was also told by our honorable chief minister in one of the interview, Sidramaya. So he's also a lawyer. Okay. In one of the interviews he has told, ಅದು ನಾನು ಎಷ್ಟೊಂದು ಪೇಜ್ ಇತ್ತು, ನಾನು ಬರ್ಕೊಂಡು 35 ಪೇಜ್ ಇತ್ತು ಬುಕ್ಲೆಟ್, ನಾನು 35 ಪೇಜ್ ಬರ್ತಿದ್ದೆ, ಅವ್ನು ಒಂದೊಂದು ಪೇಜ್ ಒಂದೊಂದು ಮಾರ್ಕ್ ಅಂತ ಕೊಟ್ಬಿಟ್ಟು 35 ಮಾರ್ಕ್ಸ್ ಪಾಸ್. ಕೇಳಿಸ್ಕೊಂಡೆ ನಂಗೆ ಐಡಿಯಾ ಬಂತು, ಕರೆಕ್ಟ್. ಅಂದ್ರೆ ಈ ತರ ಮಾಡಿದ್ರೆ ನಮ್ದು ವರ್ಕ್ ಆಗುತ್ತೆ, ನಮ್ದು CA. ಬಟ್ ಐ ಕ್ಯಾನ್ ರೈಟ್ ಸಮಥಿಂಗ್ ಆನ್ ಅಬೌಟ್ ಎವ್ರಿಥಿಂಗ್ ಅಂತ ಹೇಳಿ ನಾನು ಅಪ್ಲೈ ಮಾಡಿದಾಗ ನಮ್ಗೆ ಅದು ವರ್ಕ್ ಆಗುತ್ತೆ. ಸೊ 2 things what you have to remember for passing is: 1, 3 times revision. Second, write 100% of the paper somehow. ಅದು ಹೆಂಗ್ ಮಾಡ್ತೀರಾ ಗೊತ್ತಿಲ್ಲ, ಅದಕ್ಕೆ ಸಿಕ್ಕಾಪಟ್ಟೆ ಸ್ಪೀಡ್ ಎಂಜಾಯ್ ಮಾಡಬೇಕು, ಅವೆಲ್ಲ ಮಾಡಬೇಕು, ಅದಕ್ಕೆ ಪ್ರಾಕ್ಟೀಸ್ ಆಗಬೇಕು. Somehow enjoy and write 100 marks pakka. No one can stop you from passing in accounts. I'm talking about accounts. In ಮಾತಾಡ್ಕೊಂಡು ಇನ್ನೊಂದು ಸ್ವಲ್ಪ ಟೈಮ್ ಇದೆ. See if I have time after 2. No, I have the next class. Not possible. So what? We'll go to redemption of debentures. Samayada bhava. So then we have redemption of debentures. So what is there in redemption of debentures? Here we are repaying the debenture, like how we were repaying the preference shares. Okay, what you have to remember here? With respect to redemption, there are 2 compliances that you have to do. One is maintaining debenture redemption reserve. So what is this? Whenever you issue, I'm not talking about issue. Whenever you issue debentures, 10% of the total outstanding amount should be transferred from free reserves to DRR, called as debenture redemption reserve. How much? 10%. Not during redemption. Today only, if you have issued today, in the end of the year, see how much is outstanding. So 10 lakh is outstanding. What is 10% of 10 lakh? 1 lakh rupees you have to transfer from free reserves to debenture redemption reserve. Okay, one complaint. Complaint number 2. Say suppose you are in this year 22-23, and in the next year the debentures you are repaying. The debentures are due next year. So this year what complaints you have to do? 15% of the amount of the redemption. Say suppose 10 lakhs entirely you are redeeming in the next year. So how much is 15% of 10 lakhs? 1,50,000. You have to take, the money will be in the bank. Take that money and invest it in specified investments. Which are the specified investments? All the risk-free investments. Example of these investments are what? Securities issued by government. These are secured. Then deposits of scheduled bank. And then scheduled bank which comes under direct, which come directly under RBI. Direct supervision of RBI are called scheduled banks. Since they are under direct supervision of RBI, they are safer investments. So this 15% should be invested where? Deposits under RBI. Then your securities issued by government. Of course, government issued securities will be safe. Then all other securities or bonds which are mentioned in Indian Trusts Act. These are the secured investments where you can invest this 15% of the investment. When will you invest it? 1 year before the So say suppose redemption is happening in 22-23 this year ಇಲ್ಲೆಲ್ಲ ರಿಡೆಂಪ್ಷನ್ ಆಗ್ತದೆ. We are in 21-22 ಅಲ್ವಾ? You have to comply with this 15% investment requirement within, this is 31st March 22, 1st April 21. By this 30th April 22, you have to comply. So if redemption is happening in 22-23, you have to invest 15% of the investments in specified investments by 30th April 22 if redemption is happening in April 22 to 23. How much? 15% of the outstanding amount. What will be the entry for this? If you're investing, your investments is increasing. So debenture redemption investment account debit to bank account. Now when the redemption is actually happening in the next year 22-23, what will you do about this investment? You will, because you need money. You invested because you want to keep the money intact. Now you need the money, sell it off. Bank account debit to investment account, you got the money. What will happen to DRR? Debenture redemption reserve was there. So every year, what is the requirement of DRR? Whenever you issue, 10% of your debenture should be there in DRR. That's 10%. So say suppose you have 10 lakh outstanding. This you will repay after 5 years. In the first year, how much will you put in DRR? 10 lakh into 10% is 1 lakh. So from free reserve, when the GR or PL account debit to DRR account, you will do 1 lakh, 1 lakh. Second year again, what will you do? 1 lakh, 1 lakh? Huh? No. You have to just maintain 10%. So in the second year, what is the status of DRR? 1 lakh. Outstanding debentures? 10 lakh. 10% of it is there in DRR. Complaint. Don't do anything. Third year, maintain. Fourth year, maintain. So suppose in fourth year, you issued debentures worth 5 lakh more. Then what you have to do? Another 5 lakh into 10%. 50,000 transfer into DRR. You have to maintain it at 10% every year. The moment you issue, not during the redemption. Investment is during the redemption. 1 year before that is before 30th April of 22. And that in 22-23 redemption ಆಗ್ತಿದೆ ಅಂದ್ರೆ 30th April of 22, you should be done with the compliance. Okay. Then when redemption of debenture happens, what is the entry? Your debenture is decreasing. Debenture account debit to debentures account debit to debenture holders account. Then when you pay them off, debenture holders account debit to bank. Correct? And you pay them off. Then investment we have sold. What will happen to DRR account? The DRR account is no more required because outstanding is how much now? 0. So transfer back the DRR to general reserve. Because it came from free reserve, send it back to free reserve. Entry will be DRR account debit to general reserve. That's all. That is about your redemption of debentures. Okay. So we are done with all this. So what I tell is, so whatever doubts, I know now till exam you'll be solving many questions. No matter what doubts you have, you can ping me over WhatsApp. I will definitely reply. No doubts about it. You have my numbers, I think in the group it will be there. Okay, you can contact me. Whatever doubts you have, we'll solve. Please revise it 3 times before you go to exam. Second point. Third point, solve as many questions as possible. Because yellow, they'll not give it somewhere new. They'll not give some new question. Very rare. They will give it from existing lot only. I have only seen no. Whatever there is material is getting repeated in all the RTPs. So try to solve maximum questions. Pakka possibility of passing will be more. Okay, and fourth thing is, as I already told, 100% of the marks. Please try to attempt for 100% of the marks. 3 times revision. Then these are the things which has worked for me. Idra ಮೇಲೆ ಏನು ಹೇಳಬೇಕು ಅನ್ನೋದು ನನಗೂ ಗೊತ್ತಿಲ್ಲ. Okay, then so please solve more and more questions. Then guys, all the best. Hope to see you in CA Inter. Bye. Take GST.
Sir, what is QC benefit?